Please like, share, and subscribe. Wishing you happiness and good luck every day.
So here's the big question. Is the stock market just a giant casino, or is it actually the single greatest wealth-building machine in history? It's a huge debate, right? And people have been arguing about it forever. Well, today, we're going to try to find the answer by looking at over 200 years of hard data. And we're not just pulling numbers out of thin air. Our guide for this is the incredible book, Stocks for the Long Run, by Wharton professor Jeremy Siegel. Now, this isn't just some random finance book. A lot of people call it the Bible of long-term investing. And for good reason. It's built on a mountain of data going back 2 whole centuries. The book kicks off with this really powerful idea from the legendary investor Peter Bernstein. And what he's saying is, for our whole economic system to even function, risk has to be rewarded. I mean, think about it, right? When you buy a stock, an equity, you're betting on a company's future. You're taking a real risk. A bond, on the other hand, is just a loan. It's a legal contract that says you'll get paid back. So if taking that bigger risk of ownership didn't come with a bigger potential reward, why would anyone ever do it? The whole system would just fall apart. So that simple but powerful idea leads us right into the book's main point, its core thesis. And let me tell you, it's a bold claim. It's an idea that's been through the ringer. World Wars, the Great Depression, you name it. And it's still standing. So what is this claim? It's actually super simple. But when you really think about it, it's kind of staggering. Over 200 years, through every single boom and every terrifying bust, one thing, one asset class has come out on top. And no, it's not bonds, it's not gold, and it's definitely not cash. It's stocks. That's a huge statement, I know. So, do the numbers actually back it up? Okay, here it is. The number at the very heart of all of Siegel's research, 6.7%. And that's not just some headline number. That's the real return. That means it's the return you get after you account for inflation eating away at your money. It's what you've actually gained in purchasing power. But you know what's really wild? How stable this number is. I mean, think about everything that's happened. The dot-com bust, the absolute chaos of 2008. And yet, that 200-year average, it's barely moved. It's incredibly consistent. All right, but let's be real for a second. A 200-year average sounds great, but it doesn't mean a whole lot if you get wiped out in a single crash, right? And that brings us to the ultimate test, the big one. Could Siegel's thesis survive the 2008 global financial crisis? Yeah, this is the question, isn't it? This is the one that probably keeps a lot of investors staring at the ceiling at 3 a.m. After watching the market absolutely implode in 2008, after seeing people lose their life savings. How can anyone stand there and say stocks are a safe bet for the long run? It really feels like the biggest possible challenge to this whole idea. So to really get it, we have to go back and look at what happened. And Siegel paints a picture of a total perfect storm. It all started with this little spark. You had these rating agencies stamping their highest AAA safety rating on mortgages that were honestly super risky. That was the fuel for a massive housing bubble. And when that bubble popped, man, the dominoes just started falling, one after another. Giants like Lehman Brothers went down, and for a minute there, it looked like the whole global financial system might go with it. It got so bad the Federal Reserve had to step in with this massive, unprecedented rescue plan. So whose fault was it? Who do we blame? Well, according to Siegel, you can't just point the finger at one person or group. It was more like the whole system failed, catastrophically. You had CEOs at the big banks chasing these crazy profits. You had financial regulators who were basically asleep at the switch. And yet, of course, you had those rating agencies who were slapping safe investment labels on what were essentially ticking time bombs. The blame was just everywhere. Okay, so we've revisited the absolute chaos of the crisis. The big question is, what does that do to Siegel's big idea? Does it still hold up? Well, his argument is that, yeah, these crashes are terrifying, no doubt about it. But they're just one chapter in a much, much longer story. To get the real truth, you have to stop looking at the panic of the moment and zoom out. You have to look at the verdict of history. And when you do zoom out, well, here it is. This is the data that forms the bedrock of his whole argument. Look, over the long, long run, the pecking order is just crystal clear. Stocks, they're the engine for real growth. Bonds, they give you some stability, sure, but you're paying for it with lower returns. Gold, it's basically an inflation hedge, but you're not really getting ahead. And cash, whew, holding cash long-term is like trying to run up a down escalator. Inflation is just going to pull you backward. And this, right here, this is the fundamental problem every investor faces. When you're looking at the short term, all you see is chaos, market crashes, scary headlines on the news, and your own gut screaming, sell. It's all emotion. But if you can force yourself to look at the long term, the picture completely changes. It's not about fear, it's about the real steady drivers of wealth, things like economic growth, human innovation, and that quiet, almost magical power of reinvesting your dividends. So the message from Siegel is just undeniable. He's saying that through every single crisis, wars, financial panics, deep recessions, the people who just hung on, the ones who persisted with stocks, they were always rewarded in the end. It's like he's saying that betting against stocks is basically making a bet against human progress itself. And historically, that has always been a losing bet. Okay, but why? Why is it so consistent? What's the secret sauce? What is the fundamental engine that's driving all this and making stocks the winner time and time again? Well, it really comes down to this core idea in finance called the equity risk premium. And all that really means is it's the extra reward you get for taking on the risk of being an owner instead of just being a lender. See, if you own a bond, you're a lender. You have a legal IOU. The company has to pay you back. But if you own a stock, you're an owner. You have a claim on future profits, but those profits aren't guaranteed. And because you're taking on that extra risk, you demand a higher potential reward. And what history shows us is that the market has consistently delivered that extra reward, that premium. And this is so important to remember. A stock isn't just a number or a blinking green or red light on your screen. It's a tiny piece of a real business. A business with buildings and employees and products and customers. So when you own a diverse portfolio of stocks, you're not just gambling, you're investing in the entire engine of the economy. As companies innovate, create new things, and make more money, the value of your piece of that business grows too. And look, this isn't some conclusion he came to by looking at just one or two things. Siegel's research is just exhaustive. It's incredibly thorough. He throws everything he can at this idea to see if it breaks. He looks at investor psychology and why we go crazy during market bubbles. He looks at global investing in emerging markets. He dives into the whole value versus growth debate. He looks at taxes, flash crashes, you name it. And after all that, the central finding, it always holds up. All right, so we've gone through the history, we've talked about the theory. Now let's get to the part that really matters to all of us. How do we take all this and actually apply it to our own investments, to our own future? The game plan for success is, on the surface, incredibly simple. But actually doing it, that's the hard part. It's really difficult. So, step one, you have to embrace a long-term horizon. I'm talking thinking in decades, not days or months. Step two, diversify. Don't put all your eggs in one basket. Owning one stock is a gamble. Owning a piece of the whole market is an investment. And then step three, and this is the toughest one by far, stay the course. When things get crazy, when the market is crashing and everyone is panicking, you have to have the guts to just stick with your plan and not sell. And hey, if that last part sounds almost impossibly hard, you are definitely not alone. Siegel even brings up this quote from the famous economist John Maynard Keynes, who was writing this stuff back in 1937, right in the middle of the Great Depression. The point is, fighting your own emotions, that has always been the biggest challenge for investors. And really, that's the big takeaway from all of this. The main message of stocks for the long run isn't that this stuff is easy. It's not. The message is that for the people who have the strength, the patience, the fortitude to just stick with the plan, history shows us over and over again that it's the single most reliable way to build real long-term wealth. So, at the end of the day, the data really speaks for itself. 200 years of history have delivered a pretty clear verdict. The real challenge here isn't about understanding the numbers on a spreadsheet. It's about mastering our own fear and greed. History tells us that those who persist are the ones who get rewarded. So the only question left to ask is the one you have to ask yourself. Do you have the patience? So when it comes to finance, what does history actually tell us about investing in stocks? Today, we're going to dig into over 200 years of hard data to try and separate the real story from all the noise you see in the headlines. Let's start right here, March 2009. The financial world was, for all intents and purposes, on fire. The market had absolutely cratered. And this quote from some poor investor calling into a live TV show, it just perfectly sums up the mood. I mean, it was total despair, where the whole idea of long-term investing felt like some kind of sick joke. But was it? Okay, let's jump in the time machine and go way back to a very different era, the summer of 1929. The Roaring Twenties were in full swing. And this guy, John J. Roscoe, a top exec at General Motors. He publishes this plan for the average person to build serious wealth in the stock market. You see, he was convinced that America was on the brink of this massive industrial expansion, and he wanted everybody to get a piece of the pie. Roscoe's plan was honestly beautifully simple. Just 3 steps. You invest $15 a month into good stocks, let it ride for 20 years, and boom, you'd have $80,000. Now, that was a fortune back then. It implied a return of 24% a year, which is just unheard of. But, in the fever dream of the 1920s bull market, it felt totally possible. And here's where the story takes a massive turn. Roscoe's advice, filled with all this incredible optimism, was published at the literal, honest-to-goodness, historical peak of the market. I mean, the timing could not possibly have been worse. Just 7 weeks later, the entire foundation of the financial world just started to crack. What followed over the next 34 months was the single most devastating stock market crash in U.S. history. The market didn't just fall, it evaporated. An unbelievable 89% of its value was just gone, wiped out. Life savings vanished, and the Great Depression began. So, as you can imagine, Roscoe was publicly crucified. He got blamed for luring all these ordinary people into the market right at the very top. For decades, his advice was held up as the gold standard for terrible, foolish ideas. Forbes magazine even called him the worst offender of the whole market mania. His name basically became a punchline for bad advice. So, that's it, right? Case closed. Investing at the absolute peak right before an 89% wipeout, that has got to be the worst financial advice in history, right?
Well, this is where the story gets really, really interesting. Because if you actually look at the numbers, over the long run, the answer is a resounding no.
Okay, look at this. Let's see what would have actually happened if someone had followed Roscoe's plan, patiently putting in that $15 every single month, even through the entire crash. Get this. In less than 4 years, their portfolio would have already been outperforming super safe treasury bills. After 20 years, they'd have almost $9,000, and after 30 years, over $60,000. That's an annualized return of almost 13%. So the key takeaway here is just incredible. Even starting at the worst possible moment in history, patient investing in stocks still won. And, Roscoe's story isn't just some weird fluke. It's actually an extreme example of a much, much larger historical trend. And this chart right here illustrates it perfectly. You could argue this is the single most important chart for any long-term investor to see. It shows the real, after-inflation growth of $1 if you invested it in different things over 210 years. Let's just break that chart down into simple annual returns. Over 2 centuries, stocks have given us an average real return of 6.6% per year. What that means is your actual buying power has pretty much doubled every decade. Now, compare that to long-term bonds at 3.6%, or gold, which barely even beat inflation at 0.7%. It's not even a close contest. Stocks are in a league of their own over the long haul. But I can hear you thinking, sure, over 200 years, great. But what about the absolutely brutal crashes that we've actually lived through? And that's a totally fair question. This whole idea of long-term growth has been tested over and over again by these gut-wrenching downturns. So let's look at 3 of the biggest financial panics in modern history. We've already covered 1929, of course. But what about the dot-com bubble bursting in 2000 or the financial crisis in 2008? Each one of these was a moment of absolute paralyzing fear, just like the feeling that prompted that doorstop comment we heard at the beginning. The year 2000, man, it was brutal, especially if you were into tech stocks. The broader market, the S&P 500, got cut basically in half. And the tech-heavy NASDAQ, it lost a staggering 78% of its value. For a whole generation of investors who had only ever seen the market go up, it really felt like the end of the world. And then, just when people were feeling good again, 2008 happened. The collapse of Lehman Brothers kicked off this global panic, and it led to the deepest, scariest economic crisis since the Great Depression itself. In both of those cases, the headlines were terrifying, and the urge to just sell everything and hide under a rock was overwhelming. And yet, the market always came back, and eventually it marched on to new highs. So why is it so ridiculously hard for investors to just capture these long-term returns? Well, it really boils down to a battle between 2 different ways of thinking. You've got the emotional investor who reacts to fear and greed, right? They chase hot stocks and then they panic sell during a crash. But then you have the patient strategist, like our hypothetical person who followed Raskob's plan. They just stick to the system, they focus on the data, and they tune out all that daily noise. And this cycle of fear and greed, it's nothing new. Back in October 1929, just 2 weeks before the crash, the brilliant Yale economist Irving Fisher said this famous line: "It is the classic sound of irrational optimism." It's that belief that this time is different, which you always seem to hear right at a market peak. And here's the perfect mirror image. In September 2002, near the absolute bottom of the tech crash bear market, the legendary bond investor Bill Gross predicted the Dow would fall even further, all the way to 5,000. This is what maximum pessimism sounds like, that feeling that things are never, ever going to get better, and it often happens right at the bottom. But maybe no phrase captures this whole psychological drama better. In 1996, years before the tech bubble even burst, Fed Chair Alan Greenspan worried out loud that irrational exuberance was pumping up asset values. He was pointing directly at that dangerous cocktail of greed and optimism that fuels every single bubble. So what's the underlying force that kind of pulls everything back to reality? Well, economists have a name for it: mean reversion. The idea is actually pretty simple. Periods where you get crazy high returns, like in a bubble, they tend to be followed by periods of below-average returns. And the opposite is true too. Stock prices go wild, up and down, but they always seem to get pulled back to that stable, long-term trend line we saw in that big chart. So the crucial point is this: all the day-to-day, month-to-month, even year-to-year swings that the financial news obsesses over, they're ultimately just noise. When you zoom out and look at the big picture, they become tiny little blips on this powerful, broad upward trend that's been going for centuries. All right, let's just boil this all down to the key takeaways. First, historically, stocks have given us way better long-term after-inflation returns than other major assets. Second, as that crazy Raskov story shows, this is true even if your timing is absolutely terrible. Third, that means that time in the market is so much more powerful than trying to time the market. And finally, the clearest lesson from all of this history is that patience has been an investor's single greatest ally. Look, in the end, the financial media is always going to be shouting about the current storm. It doesn't matter if it's a bubble or a crash. The data, though, it tells a much calmer, much longer story. So the real question all of this leaves us with is a personal one. When you invest, are you looking at tomorrow's weather forecast, or are you planning for the change of seasons? What is your time horizon? The 2008 financial crisis, it wasn't just some headline. It was a global earthquake that completely reshaped our world. So today, we're going to dig into how a seemingly rock-solid global economy was brought right to the brink of collapse, and what that absolutely terrifying story means for all of us today. Check out this quote. This was a promise made by Ben Bernanke years before he would become the chairman of the Federal Reserve. He was talking to an economist who proved the Fed's mistakes made the Great Depression way worse. Bernanke was so sure, so confident, telling him they had learned their lesson. Little did he know, he was about to star in the sequel. You know, to really get a feel for the sheer scale of this crisis, we can't start at the beginning. No, we have to start right in the eye of the storm. One single week in September of 2008, when the entire global financial system basically just stared into the abyss. Okay, picture this. Monday, September 15th, Lehman Brothers, a company that was 150 years old, a firm that survived the Great Depression, just vaporized. Gone. The very next day, AIG, the biggest insurer on the planet, is in a death spiral, saved only by a massive emergency government loan. And then on Wednesday, something happens that was supposed to be impossible. A money market fund, a place people thought was safer than a bank, broke the buck. In just 3 days, the pillars of the financial world were either total rubble or on life support. The panic was immediate. The credit markets, the actual lifeblood of the economy, they just froze solid. Everybody scrambled, dumping whatever they had to buy the one and only thing they saw as truly safe U.S. government debt. And the demand was so crazy intense that the interest rate fell to 0. I want you to think about that for a second. Investors were so terrified, they were literally willing to pay the government to hold their money just so they know it would still exist the next morning. So as people around the world are watching this all go down, this one chilling question started to form in everyone's minds. From top economists to regular people. With things happening that nobody had seen since the 1930s. Was this it? Was this the beginning of a second Great Depression? The answer, terrifyingly, was maybe. So, how on earth did we get here? How did the whole system get so incredibly fragile? Well, the crazy part is the story doesn't start with chaos. It starts with a long, almost freakishly calm period that created this incredibly dangerous sense of security. Economists even had this cozy name for it, the Great Moderation. For more than 20 years, the economy just sailed on these calm waters. Recessions were short, they were shallow. It really felt like the smartest people in the world had finally cracked the code, that they'd solved the whole boom and bust thing. But this long period of peace had a really dangerous side effect. It made everyone complacent. Stability made taking on huge risks feel, well, it made it feel smart. And this is where it gets spooky because we've seen this movie before. The 1920s felt exactly the same way. This new era of calm and prosperity right before the Great Crash in 1929. In both of these periods, there was this shared, almost intoxicating belief. Don't worry, the Federal Reserve will always step in and save the day. This belief, this sort of unspoken guarantee, acted like a drug. It just encouraged bigger and bigger bets, and it was setting the stage for a truly catastrophic fall. Okay, so that feeling of total safety, that was the environment. But what were the actual weapons of mass financial destruction? Well, it really boils down to a three-part recipe for absolute disaster. Ingredient number one, and this is the big one, the subprime mortgage. These were basically home loans given to people with shaky credit, often with little or no proof of income. On their own, they were risky for sure, but Wall Street figured out a way to take thousands of these risky loans, chop them up, bundle them together, and sell them off as these new complex investments. And this whole machine, this whole system ran on one single fuel, a housing boom that was unlike anything in history. For decades, prices went up nice and steady. But then, starting in the late 90s, they just went vertical. We're talking nearly tripling in less than a decade. The logic was simple, and it was seductive. As long as prices only go up, who cares if the mortgage is risky? If someone defaults, the bank just sells the house for an easy profit. What could possibly go wrong? Right, so how in the world were these bundles of really risky mortgages seen as super safe investments? Well, they were stamped AAA, the highest rating you can get by the rating agencies. But this quote right here, this is the smoking gun. In the middle of 2007, an analyst at Fitch admits that their models would break down completely if home prices just fell by 1 or 2%. They knew. They knew their models were built on a house of cards, but they still stamped trillions of dollars of this stuff with a seal of ultimate safety. This graph really shows you just how disconnected from reality the market got. It's comparing home prices to what a typical family actually earns. And for decades, that line was pretty flat and stable. Then, after the year 2000, it just rockets up, almost 50% above the historical average. Houses weren't being priced based on what people could afford anymore. They were being priced on pure speculative fever. So, let's recap. We've got incredibly risky mortgages, we've got totally bogus safety ratings, and we have a housing bubble of historic proportions. But even all of that isn't quite enough to crash the entire world. The real poison, the secret ingredient that turned a housing problem into a global catastrophe, was leverage. I mean, the scale of this is just hard to wrap your head around. By 2007, there was almost $3 trillion in these risky mortgage securities just sloshing around the global financial system. That is more than the entire economic output of Germany at the time. But here's the real puzzle. The total potential loss from all of these mortgages was actually less than the money that disappeared in the dot-com bust back in 2000. And that event just caused a pretty mild recession. So what gives? Why did this one nearly cause another Great Depression? The answer comes down to one single word: leverage. See, in the dot-com crash, investment banks sold all those risky stocks to the public, to you and me. So when they crashed, investors lost money. But this time, oh no, the banks were their own best customers. They borrowed insane amounts of money to buy up these mortgage securities for themselves. So when the bubble finally popped, it didn't just wipe out a few investors, it blew a hole straight through the middle of the banks at the very heart of the financial system. So, with the entire banking system on the edge of complete collapse, the U.S. government and the Federal Reserve were staring down a terrifying choice: step in with more force than ever before in history, or risk a complete and total meltdown of society. Learning from the brutal lessons of the Great Depression, the Fed went into full-on five-alarm fire emergency mode. To stop the panic, they guaranteed money market funds. To bring back some faith, they insured bank deposits all the way up to $250,000. And to get the system unfrozen, they just flooded the global markets with trillions in liquidity. The mission was simple: do whatever it takes to get credit, the economy's blood, flowing again.
But the government's response was, well, it was messy and it was controversial. On September 15th, they let Lehman Brothers fail, probably hoping to teach Wall Street a lesson about risk. The chaos that followed was so bad that just one day later, they did a complete 180 and bailed out the insurance giant AIG because its failure would have been even worse. And that decision, who gets saved and who gets to fail, is something people still argue about to this day. So after the dust finally settled and the global economy was dragged back from the edge, what did we actually learn? And who do we point the finger at for this whole financial catastrophe?
The real answer is there wasn't just one single villain. The blame was absolutely everywhere. You had bank executives who were just blind to the insane risks they were taking. You had the rating agencies that were basically paid to call toxic waste gold. And then you had the official referees, the regulators, who seemed to be looking the other way while the whole system was spiraling out of control. And this analogy just nails it. Think about it. Modern cars are full of safety features, right? Airbags, anti-lock brakes, all that stuff. But none of that is going to save you if you hit a small speed bump going 120 miles an hour. Well, in 2008, the financial system was that supercar, just turbocharged with leverage and complexity. And the housing market downturn, that was the tiny speed bump. It shouldn't have been a disaster, but at that speed, it was enough to launch the whole thing into a spectacular, fiery crash. Which, of course, brings us to right now. We've definitely added more airbags and more seatbelts to the financial system since 2008. But the engine is also way faster, the technology is way more complex, and the whole global highway is more interconnected than it has ever been. So the final question really isn't if there's going to be another bump in the road. The question is, when it gets here, just how fast will we be going?
All right, today we are diving deep into one of the most important economic events of our lifetimes, the 2008 financial crisis. We're going to look at how the entire global economy was pushed right to the edge, how the markets completely panicked, and maybe most importantly, how the rules of the game were totally rewritten after all the dust settled. Let's get into it.
You know, this quote from Rahm Emanuel, right as he was about to become President Obama's chief of staff, just nails it. It perfectly frames the crisis not just as this terrible disaster, but as a catalyst, an opportunity, he called it, that would force huge and in a lot of ways, permanent changes to our financial world. So, before we get to the wild market panic and all those dramatic bailouts, you have to understand that an economic storm was already brewing. See, the financial crisis didn't just happen in a vacuum. It was like pouring gasoline on a fire that was already burning. To really get what happened, we've got to start here.
Now, this timeline, it reveals something really crucial. The recession officially began way back in December 2007. That's a full 9 months before the Lehman Brothers bankruptcy that everyone remembers. It went on for 18 brutal months, making it the longest downturn in the U.S. since the Great Depression. And unemployment, it eventually hit a staggering 10%.
But as bad as it was, context is everything. Just look at this comparison. The Great Recession, a GDP drop of 4.3%. Super painful, no doubt. But the Great Depression, GDP fell over 26%. The real difference maker, the thing that kept us from a total 1930s-style collapse, was what happened to prices. See that 27% price decline, that's deflation, back then, versus just 3.5% in our crisis. And believe me, that was no accident. The Federal Reserve was absolutely determined not to repeat the mistakes of the 1930s. They had one single overriding mission: stop deflation at all costs. Because a spiral of falling prices and wages, well, that makes everyone's debts impossible to pay back, and it would have pushed millions more people and companies over the edge. Okay, so let's shift gears to the exact moment that this nasty recession turned into an all-out, hair-on-fire panic. The economy was already struggling, but the financial markets were about to have a full-blown heart attack, and it was all triggered by the collapse of one single iconic firm. This chart right here, this is the breaking point. The black line is the stock market, the S&P 500, and that gray line, that's basically a fear gauge for the banking system. Now, watch what happens on September 15th, 2008, the day Lehman Brothers went belly up. The market just falls off a cliff, and fear goes vertical. Confidence? Poof, gone, overnight. The sheer scale of the collapse was just breathtaking.
From the market's peak to its gut-wrenching bottom in March of 2009, the S&P 500 lost almost 57% of its value. That was the worst drop in 75 years. It wiped out more than a decade of stock market gains.
And to put a dollar figure on that, just in the United States alone, we're talking about an $11 trillion decline in stock market wealth. That is an almost unimaginable amount of money. It's more than 70% of the entire U.S. economy at the time. But this wasn't just an American story, not by a long shot. The shockwave went global. All around the world, a staggering $33 trillion of stock market wealth was just vaporized. That's about half the world's entire annual economic output, gone in months. And the epicenter of this financial earthquake was, of course, the financial sector itself. I mean, just look at these numbers. It's absolute carnage. The whole sector, down 84%. But for the titans of Wall Street, it was near total annihilation. Citibank, down 98%. AIG, 99.5%. And Lehman Brothers, well, 100%. Wiped off the map.
So the panic that started on Wall Street, it didn't stay there. It escaped. It spread like a virus, infecting every single corner of the global economy and hammering asset classes that people thought were totally safe. And here's something you might not realize. Even though the crisis started in the US, you could argue its economic impact was even worse in other places. This chart shows the drop in GDP for a bunch of major economies. And if you look closely, you can see the lines for Japan and Europe actually dip even lower than the US line. The pain was truly global. This was a synchronized collapse. Everything went down together. It wasn't just stocks. Real estate lost trillions. Commodities, which had been booming, completely cratered. Oil prices went into an absolute freefall. And get this, even gold, the one thing you're supposed to buy when the world is ending, it got hammered too, because investors were so desperate they were just selling anything they could to get cash. There was literally nowhere to hide. Okay, so this chart visualizes the banking system's heart attack. That key number, the LIBOR spread, is basically just the fear gauge. It's how much extra banks charge each other to borrow money. The higher the number, the more scared they are. Before the crisis, it was tiny. As things got dicey, it grew. But after Lehman, look at that spike. It just exploded. The plumbing of the entire financial system froze solid. Banks completely stopped trusting each other. So, with the global financial system staring into the abyss, on the very verge of a complete meltdown, governments and central banks had to do something. They had to step in with unprecedented and hugely controversial actions to unfreeze the system no matter what it took. And they basically threw the kitchen sink at the problem. The response came in 3 big waves. First, the Fed slashed its main interest rate to essentially zero. Second, it pumped over $1 trillion of pure cash, liquidity, into the banking system just to get the gears turning again. And third, Congress passed TARP, a $700 billion fund to directly bail out and stabilize the very firms that were failing. Now, in the aftermath, the government tried to make sure this could never, ever happen again with this monster piece of legislation, the Dodd-Frank Act. Let's break down its 3 biggest pieces. First, the Volcker Rule tried to stop regular banks from making risky hedge fund-style bets. Second, another part created a rulebook for safely shutting down a too-big-to-fail firm so we wouldn't have another chaotic Lehman situation. And finally, they put new limits on the Fed's power to bail out individual companies.
But here's the billion-dollar question, or maybe the trillion-dollar question. Would any of this have actually prevented the 2008 crisis? The source material makes a fascinating point. The companies that really blew up the system were investment banks like Lehman and Bear Stearns, and an insurance company, AIG. None of them were the kind of commercial banks the Volcker Rule was aimed at, so it's a real debate, right? You see, the crisis didn't just lead to a bunch of new laws. It fundamentally rewired the market itself. The way different assets talk to each other completely changed, creating a brand new playbook for investors that, honestly, we're still using today. Now, this chart might look a little complicated, but the story it tells is actually really simple. Each line is just tracking how different things like commodities or bonds move compared to the stock market. Just look at the period after 2008. You can see the lines all shift like crazy. The old relationships, the old rules, they were broken. And this gave birth to a whole new market language, a phrase you hear all the time now, risk on/risk off. In this new world, it's pretty simple. On a risk-on day, good news comes out and investors buy everything considered risky. Stocks, oil, you name it.
But on a risk-off day, bad news hits and they all run for the exits at the same time, fleeing to what they think is safe: U.S. government bonds and the dollar. It's like a big switch that's either on or off.
And above everything else, the crisis cemented one asset as the undisputed king of safety: the U.S. Treasury bond. It became the world's ultimate safe harbor. Now, when stocks fall, investors just reflexively pile into Treasury bonds, pushing their prices up. This strong negative relationship has made government bonds the #1 tool for protecting against stock market risk for over a decade.
And that brings us to our big final thought. The entire playbook for the last decade was written by the 2008 crisis. But here's the thing. That perfect negative relationship between stocks and bonds, it really only works when inflation isn't a problem. So the last crisis taught an entire generation of investors that government bonds are the perfect insurance policy. But what happens if the next crisis is driven by something totally different? Something like high inflation, which makes those same bonds a terrible investment. What do you do when the safe haven is no longer safe?
Have you ever had that nagging feeling that maybe the future isn't going to be quite as bright as the past? It's a question a lot of us are asking, this sense that the standard of living we've all taken for granted might be at risk. Well, today we're going to dive deep into the powerful, often invisible forces that are shaping that future to figure out if that pessimism is really justified.
So let's start with this classic quote from the philosopher Auguste Comte: "Demography is destiny." It's a simple but profound idea. What it's really saying is that these slow-moving, almost boring trends of population, births, deaths, aging, are some of the most powerful and unavoidable forces that shape our economies. We tend to overlook them, but as we're about to see, demography is right at the heart of the challenges we face today.
All right, so here's our roadmap for this explainer. First, we'll get into this crisis of confidence so many of us are feeling. Then we'll break down the demographic shift known as the coming age wave. After that, we'll ask a pretty startling question: a world without workers. From there, we're going to pivot to the emerging economic solution, look at the new economic balance it's creating, and finally wrap it all up by looking at our global future. You know, after the Great Recession, a really deep pessimism took root across the developed world. Polls actually showed that for the first time, a lot of Americans believed their kids wouldn't be better off than they were. But here's the thing. This isn't just a vibe or a feeling. It's tied to a very real demographic problem that boils down to two fundamental questions that we absolutely have to answer. And here they are. These are the two big ones, the questions that are going to anchor our entire story today. First, with millions upon millions of baby boomers retiring, who's going to be left to actually do the work and produce everything they need? And second, as those same retirees start cashing out their 401ks, selling their stocks and bonds to pay for it all, who exactly is going to be on the other side of that trade, buying those assets? Seriously, the answers to these two questions are going to define the next 50 years.
So, let's get into the heart of the problem. It actually has a name: the age wave. And look, this wasn't something that happened overnight. It's the result of several really powerful long-term trends that have been building for decades, and now they're all hitting at once, creating a kind of perfect demographic storm.
This timeline just lays out the four key ingredients perfectly. First, you get the massive baby boom generation right after World War II. But then, almost immediately, that's followed by a baby bust, where birth rates just fell off a cliff. At the exact same time, thanks to incredible medical breakthroughs, we all started living way longer. And to top it off, we started retiring earlier. So you see the problem, right? A huge generation is heading into a much longer retirement, with a much smaller generation coming up behind them to support it all.
And this number is absolutely crucial. 2.1. That's the magic number, the number of children per woman needed just to keep a population from shrinking. But in most of the developed world, from Europe to Japan to right here in the US, the rate has fallen way below that. In some places, it's cratered. Put simply, we are just not replacing ourselves.
Now this is where it gets really wild. Look at what happens when you combine those two trends of living longer and retiring earlier. Back in 1950, the average American was retired for just over a year and a half. By 2010, that had exploded to almost 16 years. Let that sink in. An 8-fold increase in the amount of time we spend as consumers, needing goods and services, without producing them through our work. That's a massive, massive shift. And this chart just hammers home the consequence. Look at this ratio of retirees to workers in the US. In 1950, you had 14 retirees for every 100 workers. Okay, By 2013, that number had doubled to 28. And the forecast for 2060, it doubles again to 56. The weight on the shoulders of the working population is just getting heavier and heavier. So what would happen if the developed world had to solve this problem all by itself, right? What if countries like the US, Japan, and all of Europe had to rely only on their own shrinking workforces? The forecast is, to put it lightly, pretty shocking.
I mean, just look at this chart. It lays the problem out in stark visual terms. See those lines for Japan, Europe, and the USA? They aren't just going up, they're going vertical. This is not a gentle slope we're talking about. It's a demographic cliff. A trajectory like that represents a totally unsustainable strain on any economy that's trying to go it alone.
Okay, so let's connect that scary chart to real life. This is what we'll call scenario A, the go-it-alone approach. To keep the whole system from breaking, the average retirement age would have to jump from 62 all the way to 77, a 15-year increase. That completely blows past any gains in life expectancy. The whole idea of a golden age of retirement would basically be over.
But, and this is a huge but, this is where our story takes a dramatic turn. Because what if looking at this problem country by country is just the wrong way to see it? What if the solution isn't national at all, but global? In a world of interconnected trade, the age wave in one part of the world might just be balanced out by a youth wave in another. Okay, this slide right here, this is the aha moment of our entire story. Let's break down what we're looking at. On one side, you've got that demographic cliff we just talked about, that steep, scary line for the developed world. But now look at the other side. This shows the emerging economies. See how that line is rising so much more slowly? It's a gentle slope, not a cliff. They have what we don't, young, growing workforces. Their demographic destiny is the mirror image of ours. So here's the solution in a nutshell. We all live in one global economy. Those young workers in emerging markets can be the answer to both of our original questions. They can produce the goods and services that retirees in the developed world need. And as they earn and save money, they can become the buyers for all those assets, the stocks, the bonds that those same retirees need to sell. It's a perfect match.
And this whole solution is being fueled by one of the single biggest stories of our lifetime, this unbelievable shift in global economic power. The rise of emerging markets isn't just a headline you skim past. It's the engine that can rebalance the entire world economy and solve this age wave crisis.
What's so amazing about this slide is the story it tells over 120 years. Back in 1980, the developed world produced 3/4 of everything. By the end of this century, that's going to be completely flipped on its head. The emerging economies will be the ones producing 3/4 of world GDP. You can literally watch the shares for the US and Europe shrink as countries like China and India and later Africa take center stage. And who's driving all this growth? It's the explosion of a new global middle class. We're talking about 3 billion new consumers hitting the market by 2030. Their spending is projected to jump by over $34 trillion. To put that in perspective, that's more than twice the current size of the entire US economy. This is the new engine of global demand, plain and simple. So let's go back to our retirement chart. Remember that grim scenario A where the retirement age shot up to 77? Well, this is scenario B. If the emerging markets keep up their strong growth, the retirement age doesn't have to skyrocket. It just needs to rise gradually, right in line with how much longer we're living. This would keep the length of retirement stable, preserving it for generations to come. So let's just spell it out and directly answer our two big questions. Number one, who produces the goods? Workers in emerging markets. Number two, who buys the assets? High-saving investors in those same markets. Now, this leads to a pretty wild conclusion. As this whole process plays out, it's very likely that by the middle of this century, investors from places like China and India will actually own a majority of the world's biggest companies.
Okay, so this all sounds pretty optimistic. A nice, meat solution. But is this future a sure thing? Of course not. This positive scenario depends on a whole lot of things going right. We need continued productivity growth, we need open trade, and capital has to be able to flow freely. And, well, there are definitely some skeptics out there who think we may have hit a wall.
So the pessimistic argument basically goes like this. The pace of truly game-changing innovation has slowed down. Just look at this table. On the left, from 1910 to 1960, you've got electricity, indoor plumbing, the car, antibiotics, inventions that completely transformed daily life. Then look at the right, from 1960 to 2010. The inventions are incredible, don't get me wrong, the internet, mobile phones, but the argument is they just haven't had the same kind of fundamental economic kick.
But on the other hand, there is a really powerful case for optimism. First off, billions of people around the world are just now getting access to those 20th century game changers like electricity and refrigeration. Second, the internet allows for collaboration on a scale we've never seen in human history. The number of researchers and innovators worldwide has exploded, and new technology is smashing language barriers, creating a kind of truly global brain trust. Which brings us right back to where we started. For most of human history, demography really was destiny. A nation's fate was tied to the age and size of its people. But in a globalized, hyper-connected world, a world where a researcher in India can collaborate with a team in Germany and a saver in China can invest in a company in America, does that old rule still apply? That right there is the defining question for our economic future. Okay, get this. What if I told you that a single dollar invested way back at the start of the 19th century could be worth over $13 million today? It sounds kind of crazy, right? But it's not. In this explainer, we're going to unpack over 200 years of financial history, drawing from the amazing research in stocks for the long run, to see exactly how that's possible, and more importantly, what it means for us today. We're going to start with this idea from Patrick Henry, because it's really the whole point. We're not just guessing about the future, we're using the past as our map. And we have an incredible map, a massive amount of data that shows us the forces that have been creating wealth for centuries.
All right, so let's run a little thought experiment. Picture this. It's 1802, and we're starting a big financial race. We have 4 runners at the starting line, and we give each of them $1. First up, we've got a portfolio of stocks, basically owning a piece of American business. Next, we have government bonds. You're lending money to the country. Then there's gold, that ancient shiny metal. And finally, just a plain old dollar bill. They run for over 200 years. So, who's your money on?
Well, the race is over. The results are in. And let me tell you, it wasn't even close. One of these didn't just win, it completely changed the game, leaving everyone else so far behind you can't even see them in the rearview mirror anymore.
So, let's just get right to it. Who was the undisputed champion of creating wealth over the long haul? By a margin that's almost hard to wrap your head around, it was stocks. Just the simple act of owning a slice of the economy. I mean, you don't even need the numbers when you see a chart like this. Just look at that top line shooting straight for the moon. That's stocks. It's such a steep climb that it basically turns everything else into a flat line at the bottom. This isn't just a story about winning. It's a story of complete and utter domination. So what does that crazy vertical line actually mean in real money? It means that $1, that single buck invested in U.S. stocks in 1802, with all the dividends put back in, grew to nearly $13.5 million. That is the incredible, relentless power of compounding growth in action. And here's the part that really gets me. Look closely at that line. The things that felt like the absolute end of the world at the time, the Great Depression, World Wars, the 2008 meltdown, from this perspective, they're just tiny little blips on the radar. It just goes to show you that over the long haul, the engine of economic growth has been way more powerful than any single crisis.
Okay, so stocks absolutely crushed it, no question. But that was just looking at the raw dollar amount. What about the other competitors? And, what about that silent killer of wealth that was chipping away at all of them, inflation? Let's take a look at the rest of the field.
Now, it's really important to get this. Stocks and bonds are just different animals. When you buy a stock, you're an owner. You get a piece of the profits, a slice of the growth. When you buy a bond, you're basically the bank. You're a lender. You get paid back with interest, sure, but that's it. Your upside is capped. With stocks, the sky's the limit. And that difference, as we'll see, is everything.
Now for a key piece of the puzzle. To understand the story, especially in the 20th century, you have to know about the gold standard. For most of our history, money was tied to a real thing, gold. That meant you couldn't just print more of it whenever you wanted, which kept a lid on prices. But that all changed. And this chart right here shows you exactly what happened when it changed. Look at that. For over a century, the general price level was pretty stable. It went up, it went down, but it always came back. Then, boom. Right after World War II, when the world went to a system of paper money, inflation takes off like a rocket and basically never looks back. So, in this new world of constantly rising prices, how did our other assets do? Well, long-term government bonds, they turn that dollar into almost $34,000. Respectable? For sure, but not even in the same league as stocks. Gold, the classic hedge against inflation, it ended up with just over $86. And that dollar bill, it got absolutely destroyed, losing 95% of its value. Holding cash was literally a losing game.
But this all leads us to the most important question, really. Because who cares if you have $13 million if a loaf of bread costs $10 million? What really matters isn't how many dollars you have, it's what those dollars can buy. We need to find the real finish line, your actual purchasing power.
Yeah, it's not about the number of zeros on your statement, it's about what it gets you at the grocery store. So let's do this. Let's run that entire 200-year race all over again, but this time we'll adjust every single result for inflation. This is where we see what truly happened to real wealth. All right, here we go. This is the moment of truth. This chart shows the real after-inflation finish line. And, well, the story is maybe even more dramatic. After you strip away the effects of inflation, stocks are still the absolute king of the hill. That $1 grew into over $700,000 of modern-day buying power. And everyone else? Flatlined. Again. Let's just put the final after-inflation numbers right next to each other. The difference is just wild. Stocks created almost $750,000 in real wealth. Bonds, they gave you a little boost to just under $1,800. Gold basically just preserved your dollar, turning it into $4.50. And the US dollar itself was almost totally wiped out, left with just a nickel of its original value. But you know what might be the most mind-blowing part of all this? It's how incredibly consistent it's been. Look at these different time periods. We're talking about going from a farming economy through the Industrial Revolution all the way to the Information Age. We're talking Civil War, World Wars, the Great Depression, you name it. And through all of that, the real after-inflation return from owning businesses has stayed right around 6 to 7% per year. That's just amazing. Okay, but there's a fair question to ask here. Was the United States just lucky? I mean, it's a critical point. The US became the world's superpower during this time. We have to wonder if we've just been looking at the history of a one-time winner.
There's actually a name for this concern. It's called survivorship bias. It's the risk that we're making a big conclusion based on a special case. You know, if we only look at the market that did great, we might be ignoring markets that completely collapsed. So does this idea hold up if we look at the whole world?
Well, luckily for us, some researchers put that exact theory to the test. They did this huge study looking at 19 different countries, including countries that lost wars and had massive economic problems, all the way from 1900. And just take a look at the chart. In every single country, from Australia to Italy to Japan, that line for stocks is on top of the lines for bonds and bills.
The takeaway here is just massive. In every one of those 19 markets, with zero exceptions, stocks delivered a higher real return than government bonds. This outperformance isn't just an American story. It is a truly global phenomenon. So let's bring it all home. What does 2 centuries of global data really mean for you and me trying to figure all this out today?
You know, the authors of that global study titled their book Triumph of the Optimists, and that just says it all, doesn't it? The historical record is crystal clear. Over the long run, the winning strategy has been to bet on human ingenuity and progress by owning a piece of the global economy.
So this is the final thought I want to leave you with. The data shows without a doubt that stocks are volatile. They go up, they go down, and yes, it can be scary. But the lesson from 200 years of history seems to be that the greatest long-term risk to your purchasing power hasn't been owning stocks. It's been the seemingly safe choice of avoiding them altogether.
Today we're going to dig into a really powerful, kind of counterintuitive idea from Jeremy Siegel's classic Stocks for the Long Run. We're about to challenge a piece of financial advice you've probably heard your entire life, and we're going to use the insights from his chapter on risk return and portfolio allocation to do it. Let's jump in.
So let's just start with a really basic question. If you had to put your life savings somewhere for the long haul, we're talking retirement here, where would you put it to keep it absolutely 100% safe? For most of us, the answer probably feels pretty obvious.
You know, the conventional wisdom paints this crystal clear picture for us. Stocks are for growth, they're the engine, the powerhouse of your portfolio, but man, are they volatile and risky. Bonds, on the other hand, well, they're the bedrock. They're stable, they're predictable, they're low risk, they're supposed to be your safe harbor in any financial storm. This is basically investing 101, right? But what if that entire framework, that whole way of thinking, is built on a flawed definition of risk, especially when we're talking about a timeline that spans decades? What if the investment that you think is so safe is actually exposing you to the single biggest financial danger out there?
And look, this isn't some new, radical idea. Way back in 1912, the economist Irving Fisher pointed out this hidden danger in bonds. He said that when you buy a bond, you're not locking in a safe return at all. What you're really doing is making a huge bet, a speculation, that the value of your money, its actual purchasing power, won't get totally wiped out by inflation.
And that brings us to the most critical concept for this entire conversation: real return. See, it's not about how many dollars you end up with. It's about what those dollars can actually buy. The real return is what you have left after you subtract the damage from inflation. It is the only number that tells you if your wealth is actually truly growing.
Okay, so talk is cheap. Let's get into the hard data. And we're not just looking at a few years here. We are going back over 2 centuries, from 1802 all the way to 2012, to see what happens to stocks and bonds during the absolute worst-case scenarios imaginable.
All right, let's zero in on this chart, starting on the far left with a 1-year holding period. This right here perfectly shows that conventional wisdom we talked about. The black bar, that's stocks, has this massive range of outcomes. You could be up 66% or down almost 40%. The bars for bonds? Way, way tighter. So yeah, no doubt about it, in any single year, stocks are way riskier. But here is where the entire story flips on its head. Just keep your eye on the very bottom of those black bars. That's the worst-case scenario for stocks as we start moving from left to right, stretching out the time you hold your investment. Okay, now let's jump over to the 20-year holding period. Over 200 years of data, and think about what's in there. World wars, the Great Depression, crazy inflation. The absolute worst 20-year period for stocks was still a positive 1% return each year, after inflation. You never lost purchasing power.
Now look at our so-called safe asset, bonds. The worst 20-year stretch for bonds, you lost 3.1% of your purchasing power every single year. Holding bonds during that time meant your nest egg was literally cut in half in real terms, even after collecting all that interest. How safe does that sound?
And if you go out to 30 years, the gap just gets bigger. The worst case for stocks actually improves to a positive 2.6% gain per year, while bonds still lose you real money. This shows a fundamental truth. The longer you wait, the safer stocks actually become.
You can look at this in another way too. Just simple probability. In any 1 year, stocks beat bonds about 61% of the time. Better than a coin flip, sure, but it's no guarantee. But stretch that to 20 years, and suddenly stocks win almost 96% of the time. At 30 years, it's over 99%. It's almost a certainty. Time literally transforms that short-term risk into long-term reliability.
So we've seen what happens, but the really cool question is why? Why do stocks behave like this? Because it's not just random luck. There are these really powerful economic forces working under the hood.
This chart is really interesting. It shows how risk changes over time. So those dashed bars, that's what standard financial theory says should happen if returns were totally random, like a coin flip. But now look at the solid black bars. That's the actual history for stocks. You can see the risk drops way, way faster. That tells us there's something else going on, something pulling stock returns back to the center. And that something is this awesome concept called mean reversion. For stocks, it basically means that bad periods tend to be followed by good periods and good by bad. It's like the economy has a built-in self-correcting mechanism. Bonds, though, they suffer from the exact opposite, mean aversion. And that's all driven by inflation. Once inflation gets going, it tends to feed on itself, pushing bond returns deeper and deeper into the red. There's just no natural force that pulls them back. Okay, so all this history is fascinating, but what do you do with it? How does this actually translate into a real-world strategy? How should this change the way you build your own portfolio? Let's turn all this data into a practical blueprint. So this chart is called an efficient frontier, and I know it looks a little complicated, but it's not. Just think of it like a map to find the safest possible portfolio. Each one of those curved lines is a different holding period, 1 year, 2 years, all the way up to 30. And the little dot on each line, that marks the perfect mix of stocks and bonds that gave you the lowest possible risk for that specific time frame. Let's see what it tells us. Now, if you look at the 1 or 2 year lines, the answer is exactly what you'd guess. The safest portfolio is basically all bonds, And that makes total sense. If you need that money for a down payment next year, you play it safe. But just watch what happens as we move that timeline out.
Check this out. At a 5-year horizon, the portfolio with the minimum risk is no longer 100% bonds. It's actually 25% stocks. Let that sink in for a second. By adding the so-called risky asset, you actually lowered your overall risk because it helped fight off that silent killer, inflation.
Now this is where it gets really wild. Let's jump to a 20-year horizon, which is a pretty standard time frame for someone saving for retirement. To get the lowest possible risk, the ideal, safest portfolio was over half stocks. The very thing we're all taught to be so careful with becomes the foundation of long-term safety.
And what about for a 30-year horizon? The portfolio with the absolute least amount of risk was made of 68% stocks. This is the ultimate punchline of this whole thing. For a true long-term investor, stocks aren't the primary source of your risk. They are your primary weapon for fighting risk, the risk that inflation will make your savings worthless.
So what's the big takeaway from all this? I think it's that most of us just think about our timeline all wrong. We think, how long will I hold this one fund? But the real holding period, the one that truly matters for how you build your portfolio, is your entire investing lifetime, from your very first job to the very last day of your retirement. And over that enormous time span, stocks completely change their role. They go from being just a growth engine to being an essential tool for safety.
So I'll just leave you with this question. Now that you've seen how time fundamentally rewrites the rules of risk, take a minute to think about your own finances. Are you planning for next year, or are you planning for the next 40 years? What is your real investment horizon? Because the answer could, and probably should, change everything. All right, let's get right into it. We hear this phrase every single day, right? On the news, in conversations, the market. But what are we really talking about when we say the market is up or the market is down? Well, today we're going to pull back the curtain on stock indexes, which have basically become the language we use to take the temperature of our entire economy.
You've heard this a million times. I know you have. It's almost a secret handshake for anyone who follows finance. One person asks, the other says, it's up 100 points. And here's the funny thing. Nobody ever has to ask, wait, what's up 100 points? We just know. We assume they're talking about the Dow. But that little exchange, it hides this really fascinating story about how we've tried to answer a much, much bigger question.
Because let's be honest, the market isn't some single physical thing. It's this massive, sprawling, chaotic collection of thousands and thousands of companies. You've got tiny little startups, and you've got these unbelievable global giants. So how on earth do you boil all of that complexity down into one number that just goes up or down? That is the puzzle we're going to piece together today.
So here's our game plan. We're going to start with the very first attempt to answer that big question, the Dow. Then we'll see how the S&P 500 came along and did it better. After that, the NASDAQ and the tech explosion. Then we'll look at how we try to measure the whole shebang. And finally, we'll talk about what these numbers really mean for you and me.
Okay, so our story has to start way back in the late 1800s with a guy named Charles Dow. He was a journalist, and he had a problem. Every day, he needed a way to give his readers a super quick, reliable snapshot of what the stock market was doing. His solution was brilliant in its simplicity. Just average the stock prices of the most important companies of his day. It sounds obvious now, but back then, it was revolutionary. And, it started really small. Back in 1885, he was just tracking 12 stocks, and most of them are railroads. But as the American economy started changing, he realized he needed a new index just for industrial companies, and that was born in 1896. Then, by 1928, it had grown into the 30 stock index that we're all so familiar with today. Now this is what I find so fascinating. What you're looking at is basically a time capsule of the American economy. On the left, you've got the original 12 companies from 1896. These are names straight out of the industrial age. And on the right, the 30 companies from just a few years ago. The difference is it's staggering. It tells the entire story of how we went from an economy of manufacturing to one of technology and services. Yeah, that original Dow really reflected an economy you could touch and feel. We're talking about American cotton oil, American sugar, U.S. leather. These were the absolute titans of industry back then. Everything was about raw materials that were powering the nation. It was a very physical, tangible world. And today, it is a completely different universe. The Dow is full of names like Microsoft, Visa, Johnson & Johnson. And get this, of those original 12 industrial powerhouses, only one, General Electric, managed to stay in the index under its original name. That just shows you the absolutely relentless pace of change in our economy.
So, how does the Dow actually work? It uses a method called price weighting. Now, in its simplest form, you just add up the stock prices of all 30 companies and divide by 30. Of course, it's a bit more complicated to account for stock splits and things, so they use a special number called a divisor. But this simple method, it has a very, very quirky and significant flaw.
Okay, so here's the crucial thing you have to understand. In a price-weighted index like the Dow, a stock with a high share price has way more influence than a stock with a low share price. It doesn't matter how big the actual company is. So a $1 move in Visa's stock, which trades at a high price, moves the Dow just as much as a $1 move in Cisco's stock, which trades at a much lower price. It's kind of like saying the tallest player on a basketball team is the most important, not the one who scores the most points. It can give you a really distorted picture.
So that weird little flaw in how the Dow was built, well, it paved the way for something better, a new benchmark. Enter the Standard & Poor's 500, or as we all know it, the S&P 500. And it took a totally different and frankly more accurate approach to measuring the market.
See, instead of weighting by price, the S&P uses something called capitalization weighting. All that means is that a company's influence on the index is based on its total market value. You just take the share price and multiply it by all the shares out there. So in this system, the biggest companies have the biggest impact, which, that just makes way more sense, right?
And so the S&P 500, which has been around in its modern form since 1957, really became the true benchmark for professional investors. Because it tracks 500 of the largest U.S. companies, it gives a much broader and more accurate picture. It covers about 3/4 of the entire U.S. stock market's value. That's a huge slice of the pie.
But of course, the economy never stops evolving. A new kind of company started to emerge that needed a new kind of market, and with it, a brand new index. This was the dawn of the tech revolution, and its home was going to be the NASDAQ.
The NASDAQ was a total game changer. When it launched in 1971, it completely did away with the idea of a crowded, physical trading floor like the New York Stock Exchange. Instead, it was the world's first electronic stock market. It was all a computerized network, which was just a natural fit for these new, fast-moving tech companies like Microsoft and Intel that were literally just starting to reshape our world.
And the growth? Oh my gosh, it was just explosive. So the NASDAQ took 24 years to finally hit the 1,000-point mark. But then, as the dot-com boom went into total overdrive, it doubled to 2,000 in just 3 years. Then, in an absolute frenzy, it rocketed to over 5,000 in March of 2000, only to come crashing all the way back down to near 1,100 just 2.5 years later. What a ride. This just shows you the unbelievable scale of that tech bubble. At its absolute peak, the total value of companies on the NASDAQ was nearly $6 trillion. That's more than any other stock exchange on the entire planet. For one brief, dizzying moment, companies like Microsoft and Cisco were the largest corporations in the world. It was a wild, wild time.
Okay, so we've got the Dow for the 30 giants, the S&P for 500 big companies, and the NASDAQ for the tech world. But what if you're a completist? What if you want to measure everything? How do you possibly capture the value of all 5,000 plus companies traded in the U.S.? Well, the first thing you have to realize is that the stock market is not a democracy. It is incredibly top-heavy. As you can see here, the top 500 biggest companies, basically the S&P 500, they account for almost 80% of the entire market's value. All of the thousands of other companies make up a surprisingly tiny slice of the total pie. So to capture all of this, we have what are called total market indexes. You can think of them like building blocks. The Russell 1000 tracks the top 1,000 stocks, and that gets you about 90% of the market right there. The Russell 2000 tracks the next 2,000 smaller companies. You put them together, and you get the Russell 3000, which covers about 99% of everything. And if you really want the most complete picture possible, you've got indexes like the CSRP Total Market Index, which has pretty much every public stock out there.
Okay, so we've looked at all these different indexes that track the biggest companies, the tech sector, even the entire market. But this brings up a really crucial, maybe even a little cynical question. Are these indexes actually giving us a fair picture of how the market is performing?
It's a totally fair question, right? When you think about it, indexes like the S&P 500 are always kicking out the struggling companies and adding the hot new successful ones. So doesn't that kind of stack the deck? Doesn't it create what people call a survivor bias, making the performance look better than it really is?
Well, the answer, according to the research, is actually no. And here's why. Think of an index like a recipe for a cake. All the ingredients and all the instructions for how to add or remove companies are public knowledge. Everyone knows the rules. And because anyone can follow that recipe, you can buy the new stocks and sell the old ones at the exact same time the index does, you can perfectly replicate its performance. Since it's a known, repeatable strategy that anyone can follow, there's no statistical bias. The index is just doing exactly what it was designed to do.
And that leaves us with one final big idea to chew on. The Dow was created to measure an industrial economy, one built on steel and railroads. Then the Nasdaq came along to measure an information economy built on microchips and software. As our world keeps getting reshaped by incredible forces like artificial intelligence, biotechnology, and sustainable energy, you really have to wonder, what's going to be the next great engine of our economy? And what kind of index will we have to invent to measure its rise?
All right, today we're going to crack open the 55-year history of the world's most famous stock index, the S&P 500. And what we're about to find are some genuinely shocking truths about investing, about growth, and about what really truly creates wealth. And the craziest part, these truths have been hiding in plain sight this whole time. You know this quote from Robert Frost? It absolutely nails the theme for what we're diving into. When it comes to the stock market, what we think is obvious, like of course you should chase the fastest growing industries, well, that path often leads you completely astray. We're about to take a look at the road less traveled. So first things first, before we get into all the twists and turns, let's just make sure we're all on the same page. What exactly is the S&P 500 anyway?
To put it simply, think of it as the ultimate scorecard for the American corporate economy. You know, when you turn on the news and they say, the market is up today, 9 times out of 10, this is what they're talking about. It's the benchmark that pretty much every professional investor on the planet is measured against.
But, you know, the index wasn't just born overnight, fully formed. It started out way smaller back in the 20s, then became the 500 stock powerhouse we know today in 1957. And the most important thing to get from this timeline is that the S&P 500 is dynamic. It's built to change. It's constantly swapping companies in and out to try and give us an accurate snapshot of the U.S. economy at any given moment.
So if the index is a 55-year-long snapshot of the U.S. economy, what does that picture actually look like? Well, it turns out to be a pretty stunning portrait of just how radically things have changed.
Okay, now what's so cool about this slide is the story it tells with just a glance. Look back at 1957. See those top 2 bands, materials and energy? That was industrial America, and it made up nearly half the entire index. But then watch what happens over the next 55 years. They just shrink and shrink. And at the same time, look at the bottom. Financials, healthcare, and tech. They start as these tiny little slivers and then just explode. It's literally the story of our modern economy in a single chart. Looking at a chart like that, the playbook seems crystal clear, doesn't it? I mean, you just had to see where the world was headed, away from old school industry and toward tech and finance, and put all your money there. Simple. But here's our first major twist, and it is a big one. That seemingly obvious strategy, it was completely, utterly, and totally wrong. This chart right here is where that whole obvious idea just completely falls apart. Okay, so along the bottom, you have how much a sector grew, and on the side, you have how much money investors actually made. Now, if more growth meant better returns, you'd see a nice, clean line going up and to the right. But what do we see? Nothing. It's a total mess. In fact, look way over on the right, financials. It was the second fastest growing sector, but it delivered the second worst returns. And then look at energy, a shrinking sector, which delivered fantastic, well above average returns. There's just no connection. And the research on this is just stunning. It found that an incredible 90% of your total return as an investor came from the performance of the individual companies you owned. It had almost nothing to do with which hot industry they were in. It turns out, picking the right horse was way, way more important than picking the fastest race. So why does that happen? Well, it's really just human psychology. We get excited, right? We hear about the next big thing, that booming industry, and all that hype and excitement drives us to pay way too much for those stocks. And there's an iron law in investing. When you overpay for something, your future returns are almost guaranteed to be lower. Okay, so if the high-flying, fast-growing darlings weren't the ticket to riches, which companies actually delivered the best results over those 55 years? Well, The answer is just as surprising.
Just take a look at this list. I mean, wow. The absolute champions weren't the tech visionaries or the Wall Street wizards. They were overwhelmingly what you might call boring companies. Philip Morris, Coca-Cola, Colgate-Palmolive, firms that just made stuff people bought and used every single day, year in and year out, without a lot of drama. And the scale of their success it's just mind-boggling. To really put it in perspective, if you had put just $1,000 into the #1 company on that list, Philip Morris, back in 1957, and just reinvested the dividends, by 2012, it would have grown to almost $20 million.
But wait a minute. How could Philip Morris, a company that was constantly getting sued and hammered in the press, possibly be the #1 performer? Well, it's this fascinating paradox. All that bad news, all that negativity, it kept the stock price relatively low. And if you're an investor who's reinvesting your dividends, that's like a dream come true. It meant every single dividend check you got bought you more and more shares of the company on the cheap, which just supercharged your returns over time. And this all builds to our final, and I think, most shocking revelation of all. This one really challenges the whole idea of why we even have a dynamic updated stock index in the first place.
This is just incredible. Get this. If in 1957 you had simply bought all 500 original companies and then did nothing, absolutely nothing, never bought any of the new companies that were added over the years, your portfolio would have beaten the official constantly updated S&P 500 index. The old guard beat the new blood. Just amazing. Which, of course, brings us to the central question. How on earth is that even possible? How could a dusty old portfolio of 1957's giants outperform an index that was constantly adding the hottest, most innovative companies that were literally defining America's future?
The answer has a great name. It's called the winner's curse. And it's actually pretty simple when you think about it. A company only gets added to the S&P 500 after it's already become huge and successful. By that point, investors are usually in a frenzy, the hype is off the charts, and the stock price is sky high. So the index ends up buying the stock after the massive run-up, right when it's most expensive. We saw it with energy stocks in the 80s, and we really saw it with tech stocks during the dot-com bubble. The index buys the hype, and the returns that follow, well, they're not so great. So let's boil all this down. After uncovering all these wild twists and turns, what are the powerful lessons we can take from these 55 years of market history? What does this mean for you today? Okay, first and most important, remember that the growth of an industry does not automatically mean you're going to get high returns. They are not the same thing. Second, don't write off the boring companies. Lasting value is very often found in those established, profitable firms. And third, you have to be wary of hype. The price you pay for an investment is absolutely critical, and overpaying for a good story is one of the oldest mistakes in the book. The best investments, they're rarely the ones making the front page news. And that leaves us with one final thought to take away. If you apply these lessons to the world today, which of the most popular, most celebrated, high-flying companies out there right now might be the ones suffering from that same winner's curse? Which ones have a price that's just gotten way too far ahead of reality? Definitely something to think about. Welcome to The Explainer. Today, we're going to break down how one of the most powerful and honestly often overlooked forces in finance, taxes, really shapes your long-term investment success. I know it can seem like a complex topic, but getting your head around it is absolutely essential if you're serious about growing your wealth. You know, let's just kick things off with a truth that every single investor knows all too well, famously put by Benjamin Franklin. And this isn't just some witty observation, right? It's the fundamental reality that frames every financial decision we make. For investors, taxes are never an afterthought. They are a constant, a powerful, and a predictable headwind we have to navigate. And that really brings us to the core mission for any serious investor, something the legendary Sir John Templeton talked about. It's not just about what you make, it's about what you keep. And even more than that, it's about what that money can actually buy after inflation has had its way with it. This one sentence, right here, that's our guiding star for this whole explainer. Okay, let's dive in. Here's how we're going to tackle this. First, we'll frame the problem. Then we'll compare stocks and bonds after tax. We'll uncover some of the hidden advantages and disadvantages in the tax code, talk strategy, and then finally, we'll look at why the edge for stocks has actually grown over time.
So, first things first, we've got to frame the problem correctly. That means acknowledging the sheer power that taxes have over our wealth. This is not a minor detail, folks. It is a major force that can totally change our investment outcomes.
And believe me, Chief Justice John Marshall was not exaggerating here. If you don't have a smart strategy, taxes can seriously damage your returns. For most successful investors, they're the single biggest investment expense you'll ever have, so managing them effectively is everything.
All right, so let's get into the evidence and see how different assets have actually performed once taxes get into the picture. Because this is where the story gets really, really interesting. The tax code does not treat all investment income the same, not by a long shot. So if you look at tax rates going all the way back to 1913, you can see it's a complicated history. That top line shows rates for what's called ordinary income, think bond interest. And wow, those rates have been incredibly high at times. But then look at the bottom line. That's for capital gains. Notice how it's consistently different and usually lower than the rates for ordinary income. That difference is absolutely crucial.
Okay, but this is where it gets really interesting when you boil all that data down. This table shows the after-tax, after-inflation returns for investors in the highest tax bracket over a century. And the difference is just stark. Stocks managed to squeak out a positive real return of 2.7%. Meanwhile, bonds and bills, they actually lost purchasing power. This shows that the advantage stocks have before taxes gets even bigger after taxes are paid.
And this number, wow, this just brilliantly illustrates the devastating effect on fixed income. Imagine you're a top bracket investor. You put $1,000 into treasury bills back in 1946. By 2012, after you've paid your taxes and accounted for inflation, you'd be left with just $138. That is a staggering 86% loss in real purchasing power. Over that same time, that same $1,000 in stocks, it would have grown to over $5,700. So you're probably asking, okay, why? Why do stocks have this massive after-tax edge? Well, a huge piece of the puzzle is something called the deferral benefit. It's one of the most powerful concepts in investing, but a lot of people don't fully grasp it.
See, unlike the interest you get from a bond or a cash dividend, which you get taxed on every single year, the taxes on a stock's appreciation are deferred. You don't pay them until you sell. That means your money gets to grow unbothered by taxes for as long as you hold on, letting your returns compound on a much larger pre-tax base.
Okay, let's walk through a super simple example. Imagine two stocks, and they both have a 10% pre-tax return. Stock A pays it all out as a dividend, which gets taxed every year, giving you an 8% after-tax return. But stock B generates that same 10% as pure capital gain. If you just hold it for 30 years and then sell, your effective after-tax return is 9.24%. Now that 1.24% difference times per year, that is absolutely enormous over 3 decades, and it's all thanks to deferral.
But hold on, the deferral benefit isn't the whole story. There's another hidden hurdle for investors that the tax code creates, and we call it the inflation tax. And this one is especially punishing for people who trade a lot. Here's how it works. The US tax code taxes your nominal gain. Let's say you buy a stock for $100 and you sell it a year later for $105. But during that same year, inflation was also 5%. So in terms of what you can actually buy, your real purchasing power, you've made nothing. But the tax code doesn't care. It sees a $5 gain and it taxes you on it. You're literally paying tax on a phantom, inflation-driven gain.
And this chart really shows that penalty in action. See that bottom line? That represents holding something for just 1 year. As inflation goes up, your real after-tax return just plummets. Why? Because the more you trade, the more often the government gets to tax those fake nominal gains. But the longer you hold, look at those top lines, the less damaging that inflation tax becomes.
And you know, this isn't some new problem. People have tried to fix this fundamental unfairness. They've proposed indexing capital gains to inflation, which would mean you'd only pay tax on your real gain. But guess what? None of these proposals have ever become law. So for now, the inflation tax is still a major drag, especially for short-term investors. Okay, so the big question, knowing all this, is how do we actually use this information? How should we strategically place our assets to minimize this tax drag? This gets into the science of asset location, and it is a critical piece of smart financial planning. And that leads us to one of the biggest, most important questions investors face.
And the answer, well, it isn't quite as straightforward as you might think, because both of these account types have their own unique tax quirks. So there's this fundamental trade-off, right? In a regular taxable account, you get to take advantage of those lower preferential tax rates on long-term capital gains and dividends. But in a tax-deferred account, like a 401k, your money grows tax-free, sure, but every single dollar you pull out in retirement gets taxed at your higher ordinary income rate. On the flip side, the government also kind of shares your risk more in a tax-deferred account, since any losses you have effectively just reduce your future taxable withdrawals.
So, the rule of thumb for most of you who are long-term buy-and-hold investors is probably to keep stocks in your taxable accounts to get those favorable tax rates. But there are important exceptions. If you're an active trader, a tax-deferred account is way better to avoid getting hammered by short-term capital gains taxes. And certain assets, like REITs, whose income doesn't get those lower tax rates, are almost always better off inside a tax-deferred account.
All right, and for our last point, let's dig into why this tax advantage for stocks isn't just a big deal, it's actually gotten bigger over time. This isn't just some historical accident, it's the result of some really powerful long-term trends.
It really comes down to three major trends over the last few decades. First, capital gains tax rates have fallen a lot since the 1970s. Second, lower inflation has meant that inflation tax we talked about has a smaller bite. And third, and this is a big one, companies are using share buybacks way more than dividends, which automatically turns a taxable event into a tax-deferred capital gain for you, the shareholder.
So what happens when you add all that up? The effect is massive. It's estimated that these factors have boosted the real after-tax return on stocks by about 2 percentage points over the past 30 years for any given pre-tax return. That is a huge structural tailwind for anyone invested in stocks.
So the takeaway here is crystal clear. Thinking about taxes isn't just some boring accounting exercise. It is a core, fundamental component of a good long-term investment strategy. The tax code is not neutral. It actively favors long-term ownership of stocks over other assets. So I'll leave you with this question, the same one we started with. Is your investment strategy truly designed to maximize what you actually get to keep?
You know the drill. Every quarter, the entire financial world just stops and holds its breath for earnings reports. A company beats the estimate and the stock pops. It misses and, whew, watch out below. But is that single headline number, that earnings per share figure, really the whole story? Is that what a company is truly worth? Well, today, we're going to go beyond the beat and find out what's really going on.
You have heard this 1,000 times, right? It's that breathless, exciting moment that just completely fuels financial news. The numbers drop, the verdict is in, and boom, the market reacts in a fraction of a second. This is the drumbeat of Wall Street, the rhythm that seems to control everything. But what if I told you this obsession, this constant focus on beating the street, is kind of missing the point? What if the real, fundamental source of a stock's value lies somewhere much deeper? In a concept that's way more powerful than a single quarterly profit number. Let's dig in.
All right, so here's our roadmap for today. We're going to start with why everyone is so obsessed with earnings in the first place. Then we'll uncover the true source of value. We'll explore the two ways companies deliver it and see how that's changed over the last 100 years. Then we're going to decode the very tricky language of profit and finish up with what savvy investors are really looking for.
Okay, first things first. Let's be crystal clear. Earnings absolutely matter. Of course they do. They are the engine of a company, right? Profit is the fuel you get when your revenue is more than your costs. You can think of it as the raw material that all shareholder value is eventually built from. I mean, without it, you've got nothing to hand out and nothing to reinvest. But, as we're about to see, the raw material is not the finished product.
And here's the crucial idea. Earnings are just the source. They are not the value itself. The true fundamental value of any asset, I don't care if it's a rental property, a piece of art, or a share of stock, it comes from something much more tangible.
And it all comes down to this: discounted cash flows. Now I know that sounds super technical and complicated, but the idea is actually pretty simple. The real value of a stock is just the sum of all the cash it's ever going to give you, the owner, for as long as it exists. And of course, since $1 in your pocket today is worth more than a promise of $1 10 years from now, we have to discount all that future cash to figure out what it's worth right here, right now.
So how do we discount that future cash? Well, it really boils down to three key factors. First, the risk-free rate. That's basically what you could earn on a super safe government bond.
Second, you've got inflation, the rate at which your money is losing its buying power. And third, something called the equity risk premium. That's the extra return you demand for taking on the risk of owning a stock instead of that safe bond. You put those three together, and that gives you your discount rate.
You know, the legendary analyst John Burr Williams just nailed it way back in 1938. He said earnings are only a means to an end, and the means should not be mistaken for the end. Earnings are the means, but the end, the entire point of this whole exercise, is the actual cash that winds up in a shareholder's pocket. If you confuse the two, you can end up getting a company's real value spectacularly wrong.
So how does a company actually turn those earnings into that valuable cash for its owners? Well, when you get right down to it, there are really only two paths it can take.
Path number one is the most direct, the most obvious: cash dividends. The company just takes some of its profits and sends a check directly to its shareholders. Simple. The second path is to keep the profits, we call those retained earnings, and plow them back into the business with the goal of making the whole company more valuable and hopefully making the stock price go up over time.
Now, when a company keeps its earnings, it has some really powerful options. It can pay down debt, which lowers interest costs and frees up future cash. It can invest in new factories, fund cool new projects, or even buy other companies. And a really popular move these days is to buy back its own stock. By reducing the number of shares out there, each one that's left represents a bigger piece of the pie, which in theory should make it more valuable.
This whole choice, between paying out dividends or retaining earnings, it isn't just some dusty theoretical debate. It actually represents a massive, century-long shift in how American companies have decided to reward their owners. Let's take a look at the data.
This chart tells such a fascinating story, spanning 140 years. Just look at it. Before World War II, you can see the solid black line. That's real earnings. And the gray line, that's real dividends. They pretty much move together, right, in lockstep? But then, look what happens after 1945. Something fundamentally changes. That earnings line just starts climbing like a rocket, while the dividend line, well, it grows much, much more slowly. This is the start of what we call the Great Divergence.
And this table here shows us exactly why that divergence happened. Check out the payout ratio. Before the war, companies were paying out over 71% of their profits as cash dividends. They were basically just dividend machines. But in the post-war era, that ratio completely tanks, falling to less than 50%. This was a historic shift. Companies started keeping way more of their earnings to reinvest for future growth.
So, with dividends becoming a much smaller piece of the pie, you'd think investors would have been worse off, right? Less cash in your pocket. Well, here is the absolute shocker. The total return for shareholders was almost identical. In the dividend-heavy era before the war, it was 6.61% per year. In the growth-focused era after, it was 6.35%. It's amazing. What investors lost in dividends, they made up for almost perfectly in capital gains from those rising stock prices.
So why the big change? Well, a few key things happened. After the war, taxes on dividends shot up, which made them a lot less attractive. Plus, you have to pay taxes on dividends the year you get them, but you only pay taxes on capital gains when you actually sell the stock, so you can put off that tax bill. And finally, you saw the rise of stock options for executives, which created this huge incentive for management to do everything they could to boost the share price, instead of just paying out dividends.
Okay, so we know that earnings, whether they're paid out or reinvested, are the ultimate source of value. But this is where the story gets a little weird. It turns out that simple word, profit, isn't nearly as straightforward as it seems. There are different ways to count it, and the difference between them can be, enormous. On one side, you have what's called GAAP earnings. GAAP stands for Generally Accepted Accounting Principles. These are the official, strict, government-approved rules. This is the number you'll find buried in a company's annual report. But then on the other side, you have operating earnings. This is a much friendlier number that companies love to talk about because it often leaves out what they call one-time or extraordinary items. Think of this table as our secret decoder ring. It shows you exactly what kind of stuff gets kicked out of those more flattering operating earnings. Just look at the items on this list. Asset write-downs, severance costs, plant closings, lawsuits. These are all very real costs to a business, right? But they can be completely stripped out of the number that companies often put in the headline.
And believe me, this isn't just some small accounting difference. Look at this chart. During normal times, the different earnings measures, they track each other pretty closely. But look what happens during a recession, like in the early 2000s or after 2008. The official GAAP earnings line just falls off a cliff, while the company-reported operating earnings just take a little dip. The gap becomes a total chasm.
And to put a really fine point on it, let's look at 2008, right in the middle of the Great Recession. According to the official GAAP rulebook, the companies in the S&P 500 earned just $12.54 per share. But the operating earnings that those exact same companies reported, a much, much healthier $50.84 per share. I mean, that is a staggering difference. It just goes to show you how much wiggle room companies have in presenting their performance.
Okay, so we now know the headline number can be tricky, and that real value comes from cash. So what do we do with this information? Well, we can use it by looking past that one beat or miss number and just digging one single layer deeper into that quarterly report.
Here's a quick checklist for you. First, look at revenue. Are sales actually growing, or are they just squeezing profits out of a shrinking business? Second, profit margins. Is the company getting better or worse at turning $1 of sales into a penny of profit? Third, the share count. Is earnings per share going up just because the company's buying back tons of stock, even if the total company profit is flat? And finally, and maybe most importantly, forward guidance. Forget the last 3 months. What is management telling you about the future? That is often the biggest news of all.
So the next time you hear that breathless report about a company beating the street by a penny, you'll know. You'll know to look for the bigger story. You'll know that the crucial question isn't just about the accounting profit for the last 90 days, but about the sustainable long-term cash a business can generate. So the ultimate question becomes, are you going to ask about the profit, or are you going to ask about the cash?
So is the stock market expensive, or is it cheap? I mean, that's the billion-dollar question every single investor asks, right? For decades, we've tried to answer it with this whole toolkit of different yardsticks and ratios, but how well do these tools actually work? Well, today we're going to dive into this and explore the fascinating and often really flawed ways we try to value the entire market.
You know, this quote from Benjamin Graham and David Dodd, the godfathers of value investing, it really nails it. We all want a logical reason, a solid number, to back up our investment choices, even when, deep down, we're just kind of chasing a hot trend. And for a very, very long time, investors thought they had found the perfect, foolproof rule.
And it was an ironclad rule, really, built on what felt like pure common sense. For generations, if you wanted to know if stocks were a good buy, you just had to compare them to one other thing: bonds. The logic was super simple and seemed totally unbreakable.
Now take a look at this. It shows you just how clear that old rule was. The dotted line, that's the dividend yield. Think of it as the annual cash reward you get for owning a stock. The solid line is the bond yield, which is the return you get from much safer government bonds. And for decades, you can see the stock yield was always higher, which makes perfect sense, right? Stocks are riskier, so of course investors demanded a bigger reward to take on that extra risk.
But then, in the summer of 1958, the unthinkable happened. This fundamental law of investing just completely flipped on its head. And the financial press at the time, they freaked out. Businessweek called it an evil omen, warning everyone that a huge market crash was right around the corner, just like the one in 1929.
And this chart just brilliantly illustrates the danger of clinging to old rules. You can see the exact crossover point right there. The solid line for bonds jumps above the dotted line for stocks. Now imagine you're an investor who saw this so-called omen and sold all of your stocks. You would have had to wait 50 years, all the way until the 2009 financial crisis, to get back in. And in all that time, you would have missed one of the greatest bull markets in history. It's a huge lesson that the world can and does change.
So here's our game plan for today. We'll start with that story of the 1958 evil omen. Then we'll get into the basics and ask, what is a PE ratio? From there, we'll look at Shiller's smarter version of it, the CAPE. Then we'll explore what happens when the numbers lie, touch on more tools, more problems, and wrap it all up by asking the big question: are old rules obsolete?
All right, let's kick things off with the granddaddy of all valuation tools, the one you see everywhere, the price-to-earnings ratio, or PE. It's the market's most famous yardstick for a very good reason.
So, how does it actually work? Well, the PE ratio is just the price of a stock divided by its earnings per share. Think of it like a price tag. If a stock has a PE of, say, 15, it means investors are willing to pay $15 for every $1 of that company's current profit. A high PE suggests everyone's really optimistic. A low PE might mean you found a bargain. But, and this is a big but, this simple ratio has a massive weakness. It can be incredibly misleading, especially when things in the economy get ugly.
Just look at this chart. That solid line is the standard PE ratio, and it is a mess. It's all over the place. And see that absolutely insane spike back in 2009? The market's PE shot up to over 123. But here's the crazy part. It wasn't because stock prices were rocketing to the moon. It was the exact opposite. During the financial crisis, corporate earnings completely collapsed. So the E in our PE ratio got tiny, sending the whole thing into the stratosphere. It made the market look absurdly expensive right at the very moment it was actually hitting rock bottom.
So that brings us to our next section. That wild volatility problem we just saw, it led Nobel Prize-winning economist Robert Shiller to come up with a better way, a tool designed specifically to smooth out all that noise from the business cycle.
It's called the CAPE ratio. That stands for cyclically adjusted price to earnings, and the idea is pretty brilliant. Instead of using just the last year's earnings, which we now know can be super volatile, CAPE uses the average of the last 10 years of earnings, and it adjusts them for inflation. The whole point is to get a much more stable, long-term picture of what a company can really earn.
And you can see it right here in action. On this chart, that dashed line is the CAPE ratio. I mean, just look at the difference. While the regular one-year PE is having a total meltdown, the CAPE ratio gives this much calmer, much more coherent signal. It completely smooths out that ridiculous spike in 2009 and gives a picture that actually makes sense.
And here's where it gets really interesting. CAPE has actually been an incredibly powerful forecasting tool. This chart compares the CAPE forecast, that's the dotted line, with what the stock market actually did over the next 10 years. And it's pretty amazing. When the CAPE ratio was high, like back in 2000, it correctly predicted a decade of pretty lousy returns. When it's been low, it's predicted strong returns. In fact, Shiller actually used this data to warn the Federal Reserve that the market was overvalued way back in 1996, right before Alan Greenspan gave his famous irrational exuberance speech.
So CAPE seems like the holy grail, the perfect tool, right? A stable, long-term predictor. But this is where the story gets a whole lot more complicated, because even our smartest tools can have some serious hidden flaws. This presents a real puzzle. If CAPE is such a great predictor, then why has it been flashing a warning sign for most of the last 3 decades? I mean, for a period that included some absolutely massive bull markets, the CAPE ratio has been sitting way above its historical average, basically screaming that the market is expensive. So, what's going on here?
What's so fascinating here is that the answer you get depends entirely on which numbers you use for earnings. The top line on this chart uses standard reported earnings, which have to follow strict accounting rules, and yeah, it looks pretty bearish. But if you use something called operating earnings, which focuses more on a company's day-to-day business, or another measure, the picture changes dramatically. Suddenly, the market looks a whole lot less scary. So why are those standard reported earnings so distorted?
Well, the problem actually has a name. It's called aggregation bias. It's a weird statistical quirk that happens when you try to calculate the PE for a whole index, like the S&P 500. The way the math works, huge losses from just a few struggling companies can actually overwhelm all the healthy profits from all the other companies, making the entire market look artificially expensive.
Okay, let's just walk through a really simple example of how this works. You've got Firm A, a big, healthy company with a totally normal PE of 15. Then you have Firm B, a smaller company that's in big trouble and loses $9 billion. When you combine them into an index, their total earnings are just $1 billion. Now, divide their total market value by those tiny earnings, and you get a completely bonkers PE ratio of 160. This is exactly what happened during the tech bust and again in the 2008 financial crisis.
All right, so that brings us to our next section. We've seen that the simple PE and even the smarter CAPE ratio have their problems. But what about the other tools in the investor's kit? Well, as we're about to see, the more yardsticks you look at, the more complications you tend to find. So first up is something called the Fed model. It's a lot like that old rule we started with, but instead of dividends, it compares the stock market's earnings yield to the bond yield. And this worked pretty well when inflation was the big bad wolf everyone was worried about. The problem is, it completely falls apart when the main fear is deflation, or falling prices. In that world, a guaranteed payout from a safe bond is golden, while company profits get crushed, making the whole comparison pretty useless.
Other metrics can also look pretty alarming at first glance. On the left, you've got corporate profits as a slice of the entire economy, and they're near record highs. Same thing on the right with profit margins. A lot of people see this and immediately start yelling that a crash is coming. But there are logical, structural reasons for this. For one, a lot more small businesses are incorporated now, which just moves profits around on the national spreadsheet. And two, U.S. companies now make a huge amount of their money overseas. So these might not be signs of a bubble, but signs of a changing economy.
And all of this leads us to our final and maybe most important section. Are the old rules obsolete? I mean, have the fundamental conditions of the economy changed so much that the historical averages we've always used as our guideposts are just no longer relevant?
Well, there are at least 3 powerful arguments for why today's market might actually deserve a permanently higher valuation. First, it's way, way cheaper to invest. A century ago, just buying and selling stocks could cost you 1 or 2% of your return every year. Today, it's basically free. Second, real bond returns are incredibly low. When safe bonds are offering you next to nothing, stocks just look a lot more attractive in comparison. And third, something called the equity risk premium might be shrinking. That's the extra return investors used to demand for taking the risk of stocks over safe bonds. After decades of data showing stocks win in the long run, investors might just be getting more comfortable with that risk.
So we started this journey looking for a simple yardstick, a number to tell us if the market is cheap or expensive. But what we've really found is that the valuation rules themselves aren't set in stone. They change as the economy changes. And that leaves us with a final, much deeper question. Maybe the goal isn't just to measure today's market against the yardsticks of the past, but to understand the powerful economic forces that might justify why today's market deserves a new one altogether.
You know, when it comes to the stock market, we hear one thing over and over. It's all about growth. Find the next big thing, right? The company that's going to change the world. But what if that's not the whole story? What if the data tells us something completely different, something surprising? Well, today, we're going to follow that data, and trust me, it leads to a place you might not expect.
So here's the plan. We're going to start with a pretty wild stock race from back in the day. Then we'll figure out why the obvious winner wasn't. After that, we'll break down the 2 key factors that have historically just crushed it. We'll see what happens when you mash them together, expose a really common investor trap, and finally get into the why this all works, and what it actually means for you.
All right, let's jump in our time machine. We're going to watch a head-to-head battle between 2 absolute giants. And their 60-year race is going to set up a fascinating mystery about what really, truly creates wealth in the stock market.
Okay, picture this. It's 1950. You've got $1,000, which was a lot of money back then, and you're going to invest it for your great-grandkids. You can't touch it for 62 years, until 2012. You've got 2 choices. And this isn't just a history lesson. The choice you make here gets right to the heart of how investing really works. So in one corner, you've got IBM, the exciting choice, right? The innovator. The dawn of the computer age. This is the future. And in the other corner, you've got Standard Oil of New Jersey. You know them today as ExxonMobil. They're established, they're huge, and let's be honest, they're kind of boring. So where are you going to put your money? The exciting tech story or the old oil giant? At first glance, this looks like the easiest decision ever. I mean, look at this table. By every single metric Wall Street goes crazy for, IBM is the hands-down winner. Revenue growth, IBM. Dividend growth, IBM. Earnings growth, oh my gosh, IBM by a mile. The whole tech industry was exploding, while oil's market share was actually shrinking. This looks like a total slam dunk for IBM, doesn't it? But here's where it gets crazy. If you had put that $1,000 into good old boring Standard Oil, 62 years later, you would have opened that account to find this, $1,620,000. That was more than double what the IBM investment returned. How is that even possible? The answer to that $1 million or multi-million-dollar question isn't about growth or stories or innovation. Nope, it's about a much simpler but way more powerful concept. And it explains not just this crazy result, but so much more about how the market actually works. The secret was hiding in plain sight this whole time. The winner wasn't the company with the better story, it was the one with the better valuation. See, while IBM's stock price did grow faster, Standard Oil was just pumping out cash. It paid a much bigger dividend. And look here, at the price-to-earnings ratio. That's the price you pay for $1 of profit. Standard Oil's was just 14. IBM's? Over 25. People were paying a huge premium for that exciting IBM story. Standard Oil was just cheaper. And over 62 years, cheap made all the difference. So let's be totally clear on what valuation means. It's super simple. It's just the price you pay for the real stuff, the actual earnings and dividends you get back as an owner of the business. The IBM story proves it. A wonderful company isn't always a wonderful investment if you pay way too much for it. And hey, this is not a new idea. The godfathers of value investing, Benjamin Graham and David Dodd, were saying this way back in 1940.
They knew that stock prices are often just driven by feelings, by hype, by a welter of human reactions, not just by spreadsheets. And that creates a gap between a stock's price and its true value.
Okay, so we've established that valuation is a huge deal. But the IBM story is just one story. Well, decades of academic research have found two super consistent, really powerful factors that explain why some stocks outperform. Let's dig into the first one, the size of the company.
This chart shows an absolutely incredible long-term trend. It tracks small companies, we call them small caps, versus their big cap brothers, all the way back to 1926. And you can see it right there. Even though they move together, that dotted line for the small guys just consistently pulls away, ending up way, way higher.
And if you put some hard numbers to it, man, it's just staggering. So if you slice up the market into 10 groups based on size, that top row, the smallest 10%, delivered an average annual return of over 17%. That completely demolishes the market average of under 10%. This size effect is a real, powerful, historically proven thing.
So smaller companies tend to do better. Got it. But what about that other idea from our IBM story? You know, the valuation part? Let's look at the second major factor, finding companies that are cheap compared to how their business is actually doing. So how do we measure cheap? Well, there are a few classic ways. Two of the most effective are looking for stocks with high dividend yields, that means they're paying out a ton of cash compared to their price, and stocks with low price-to-earnings, or PE ratios. Both of these are classic signs of what we call a value stock. Okay, let's look at the proof for dividends. This chart sorts the S&P 500 into 5 buckets based on how much of a dividend they pay. And the result is just stunning. That top line is the group with the highest dividends. $1,000 invested there from 1957 to 2012 grew to over $678,000. The S&P 500 itself, only $202,000. A simple strategy of just buying the high dividend payers more than tripled the market's return. And if you thought that was wild, the evidence for the PE ratio is even more dramatic. The line at the very top, those are the stocks with the lowest PE ratios, the cheapest ones. $1,000 there exploded to almost $800,000. Now, look at the bottom line. Those are the stocks with the highest PE ratios, the expensive, popular growth darlings. They only grew to $64,000. The difference is just, it's breathtaking. So, we've seen that small stocks tend to do better, and we've seen that cheap stocks tend to do better. So the obvious question is, what happens when you put these two absolute powerhouses together? This is where the story gets really good. This chart says it all. The top line is small cap value stocks, companies that are both small and cheap. The bottom line is small cap growth stocks, small but expensive and popular. And that performance gap, it's not a gap. It's a canyon. It's a chasm. This is, without a doubt, the most powerful combination we have seen yet.
Must just put some numbers to that chasm to really let it sink in. $1,000 invested in that top category of small, cheap stocks grew to almost $8 million. That same $1,000 in small, expensive stocks, it turned into just over $12,000. That is not a small difference. That is a life-changing, generational wealth-creating difference.
Which brings us to a huge and super common trap, chasing IPOs, or initial public offerings. These are often the ultimate small growth stocks, right? They're dripping with hype and amazing stories. But the data here is just brutal. This chart shows how a portfolio of IPOs did against a simple small cap index. In 29 out of 33 years, the IPOs lost. The hype, on average, just does not pay off. So you have to be wondering, why? Why do these patterns keep showing up, decade after decade? If it's this obvious, why doesn't the market just fix it? Well, the answer comes down to human behavior. And if you understand it, it can give you a serious edge. One of the best explanations is something called the noisy market hypothesis. It basically says that a ton of the buying and selling out there isn't based on careful analysis. It's just noise. People trading for tax reasons, or because they have to rebalance, or because they're just chasing a hot story they saw on TV. All this noise pushes prices away from what they're really worth. The popular growth stocks get bid up way too high, and the boring, neglected value stocks get sold down too low. And over time, those prices tend to snap back to reality, and that's what creates these incredible long-term returns.
So what it all boils down to is this. A great company and a great investment are two totally different things. The historical evidence is overwhelming that the price you pay is one of the most, if not the most, critical factors for your future returns. So I'll just leave you with this question. The next time you hear a fantastic, can't-miss story about a stock that's going to change the world, will you remember to stop and ask about its price tag?
Welcome to The Explainer. You know, if I asked you where to invest your money to get the absolute best returns, you'd probably say, well, the fastest growing country, right? I mean, it just sounds obvious. But what if I told you the data says that's one of the worst things you could possibly do? Today, we're going to flip that whole idea on its head and show you what it really means to build a smart, truly global portfolio. So let's start with this quote from the legendary investor John Templeton. He said this way back in 1984 when global investing wasn't really a thing for most people. He was already seeing the future, a future where the best opportunities knew no borders. And this chart really puts that reality into perspective. It's kind of hard to imagine now, but right after World War II, the US stock market made up almost 90% of global equity. But look at this pie chart from 2012. The US slice has dropped to less than half. The investment universe has literally expanded all around us.
So what does that mean in practical terms? It means this: 52.8%. That's the chunk of the world's publicly traded companies that are headquartered outside the United States. If you're only investing domestically, you're literally leaving more than half of the game on the sidelines. Okay, so this leads to the big question then. If you're ready to tap into that other 52.8%, where do you even begin? How do you find the best strategy to actually capture those global returns? Now, the story we're always told, the conventional wisdom, is simple. Find the countries with the fastest growing economies and just put your money there. On the surface, it makes perfect sense. Fast economic growth has to equal high stock returns, right? All right, let's put that theory to the test. Take a look at these two charts. On the bottom axis, you've got economic growth. Faster growth is to the right. On the side axis, you've got stock market returns. The top chart is for developed countries. The bottom is for developing ones. Now, you'd expect the line to go up and to the right, but look at the trend line on both. It does the exact opposite. This is the core of the whole myth. The data shows a negative correlation. Just let that sink in for a second. On average, the faster a country's economy grew, the lower its stock market returns were for investors. It's like a seesaw. When economic growth goes up, stock returns tend to go down. And this holds true for both developed and developing countries. And it just completely shatters that conventional wisdom. And China is the perfect example of this trap. I mean, for decades, it was the world's undisputed growth engine. But investors who piled in, well, they saw the worst returns on the chart. And you have to ask why. Because that incredible growth story was already priced in, pushing valuations to insane heights. Meanwhile, investors in a slower growth country like Mexico, who focused on value instead of hype, did incredibly well. So, if chasing fast-growing economies is a trap, you might be wondering, well, why bother investing globally at all then? And that brings us to the real superpower of a global portfolio. It's not about chasing growth. It's about diversification. Diversification is pretty much the only free lunch in investing. The whole idea is to build a more resilient portfolio by owning things that don't all rise and fall at the exact same time. You're simply not putting all your financial eggs in one country's basket. And this table here, it shows the magic of diversification in action. Just look at that correlation column. It shows how often other markets move in the same direction as the US market. For other developed countries, it's about 65% of the time. For emerging markets, it's only about 52%. Because they aren't perfectly in sync, when one market is down, another might be up, which helps smooth out the bumps in your portfolio and actually reduce your overall risk. And here's another interesting layer. When you invest abroad, you're dealing with two types of risk: the stock's performance in its own currency, and then the fluctuation of that currency against your own. But what's really fascinating is that these two risks often work against each other. For example, a falling local currency might actually boost the profits of a company based there that exports a lot, creating this kind of natural hedge that can further reduce the volatility in your portfolio. To really drive home the danger of putting all your eggs in one basket, especially one that seems unstoppable, let's look at one of the most dramatic cautionary tales in modern financial history. This timeline is just staggering. Through the 70s and 80s, the Japanese stock market was this unstoppable force. By the end of 1989, it was the largest market in the entire world. It felt like it could never, ever go down. But then, the bubble burst. And look at this. Nearly 2 decades later, the market was still down, over 80%. A lost generation for investors who bet everything on one sure thing.
And this was the kind of thinking that was fueling the fire. When a skeptic in 1987 questioned the sky-high prices, this was the response he got. It's the 4 most dangerous words in investing. This time is different. It's the classic sign of a bubble, when investors decide that the old rules of history and valuation just don't apply anymore.
So, how crazy did it get? Well, at the very peak of the bubble, the average stock in Japan was trading for more than 100 times its annual earnings. 100 times. That's a valuation that just defies all logic and history, a massive red flag that everyone chose to speed right past.
Okay, so the lessons from the past are pretty clear. Don't chase growth and don't put all your eggs in one basket. This leads us to a more modern and, frankly, a much more logical way to think about building a global portfolio for the future.
Historically, we've organized our international investments based on what country a company is headquartered in. But in a globalized world, that's starting to feel, well, a little outdated. The source material argues that a far more logical approach is to think in terms of global sectors, grouping companies by what they do, not where their mailbox is.
I mean, think about the energy industry. You have giants like Exxon in the US, PetroChina in China, and Shell in the Netherlands. Do they have more in common with each other because they're all in the oil and gas business, or with a bank from their own home country? Grouping them by industry just makes way more sense in a world where business is global.
So let's put all these pieces together. We've busted the growth myth, and we've seen the real power of diversification. What does this actually mean for how you should build your own portfolio? I absolutely love this analogy from the source material. Imagine a financial advisor telling you, you should only invest in companies whose names start with the letters A through F. You'd think they were crazy, right? It's a totally arbitrary and foolish limitation. But investing only in US stocks is fundamentally the same bet, an arbitrary line drawn on a map, especially as the US represents a shrinking piece of the global economic pie. And this is the ultimate takeaway. True diversification isn't just about owning 100 different US stocks. It's about owning the world's economy. Spreading your investments across different countries and different currencies is the most reliable way to build wealth over the long term while managing your risk. And so we'll leave you with this question to think about. As national borders become less and less important for global business, take a hard look at your own portfolio. Is it built on the myths of the past, or is it actually ready for the reality of the future? Thanks for joining us on The Explainer. Today, we're going to get into the really powerful and, let's be honest, often misunderstood relationship between money, the economy, and, well, your investments. We're going to take a journey to see how we went from a world where money was backed by solid gold to a world run by central banks, and most importantly, what it all means for you. So let's just jump right into the core debate. On one side, you've got a legend, Martin Zweig, an absolute master of market timing, who believed that what the central bank does with money is pretty much everything. And on the other side, you have Warren Buffett, the ultimate long-term guy, who basically says he couldn't care less what the Federal Reserve is up to. I mean, 2 titans of investing with 2 completely opposite philosophies. So, who's right? Does the Fed really pull all the strings? Or is it all just background noise that smart investors should ignore? Well, to figure this out, we're not going to start with spreadsheets. We're going to start with a story. A really bizarre and absolutely pivotal moment in financial history, all the way back in 1931. Okay, so here's the game plan. We'll kick things off with that historical mystery, then we'll trace how the dollar got unchained from gold. From there, we'll enter the age of inflation, see how the Fed stepped in to take control, and finally, we'll bring it all home to figure out what this means for your money over the long run. All right, let's dive into part 1, a crisis worth cheering, the paradox of 1931. I want you to picture this. It's September 1931. The world is in the absolute pits of the Great Depression. Britain, a global economic superpower, just announced it's ditching the gold standard. Officials are predicting total Armageddon, a world financial crisis of unprecedented dimensions. They even shut down the London Stock Exchange to stop a meltdown. But when it reopens, the brokers aren't screaming in terror. They're cheering, laughing like schoolboys. What in the world was going on here?
This moment, this one weird reaction, it tells us everything. Those investors weren't crazy. They understood something critical that the politicians missed. Being tied to gold was like a financial straitjacket. By cutting that cord, the government could finally expand credit, pump liquidity into the system, and fight the depression. See, markets don't love gold, they love liquidity. And when the US did the exact same thing in 1933, the stock market had the greatest two-day rally in its entire history.
So that's the what. Now let's dig into the how. This brings us to part 2, unchaining the dollar, the slow death of the gold standard. So what exactly was this gold standard that everyone was so desperate to get rid of? Well, it was actually pretty simple. Your paper money was basically a claim ticket for a fixed amount of gold that the government had locked away. Now, the big plus was that it kept prices incredibly stable for centuries. But the fatal flaw? It gave the central bank zero flexibility. When a panic hit and everyone wanted their cash, the bank couldn't just create more. It was completely trapped. You can see here that the end didn't happen overnight. It came in stages. Britain was the first domino to fall in 31. Then the US followed in 33, right in the heart of the Depression. But the final nail in the coffin came in 1971. That's when President Nixon went on TV and announced the US would no longer trade its dollars for gold with other countries. And just like that, the 200-year era of gold-backed money was over.
Leaving gold behind threw us directly into our next chapter, the age of inflation. We were suddenly in a brand new world of fiat money, money that's backed by nothing but faith in the government that issued it. And, well, that changed everything.
And this really shows you the hidden cost of this new system. Get this. Back in 1950, President Truman made a bold prediction that the median family income would one day hit $12,000 by the year 2000. Well, we blew past that. We hit over $41,000. But here's the gut punch. After you adjust for all the inflation between those years, that 41 grand was only worth about $6,000 in 1950 dollars. A huge piece of what we thought was progress, it was just an illusion.
This chart right here shows you exactly why that happened. For more than a century, you can see the Consumer Price Index, that's the solid line. It bounces around, sure, but it always comes back to a stable baseline. It was anchored by the money supply, which was tied to gold. But just look what happens after World War II, once that anchor is gone. Both the money supply and prices take off on a one-way trip to the moon. The link is just undeniable. When you have more money chasing the same amount of stuff, you get inflation. Which, of course, brings us to the institution that sits right at the center of this new world. Part 4, the Fed takes control, managing modern money. So how does the Fed actually print all this new money? Well, it's not a giant printing press. It's a process called open market operations, and it's simpler than you might think. Step 1, the Fed buys something like a government bond from a bank. Step 2, it pays for it by just typing numbers into a computer, adding money to that bank's reserve account. Poof! New money, created out of thin air. And step 3, the bank then lends that new money out into the economy. This is the very process Martin Zweig was obsessed with, because he saw it as rocket fuel for the stock market. Now, by doing this, by adding or removing reserves from the banking system, the Fed gets to control its #1 policy tool, the federal funds rate. This is basically the interest rate that banks charge each other for overnight loans of those very reserves we just talked about. By pushing this one rate up or down, the Fed sets the tone for everything, from your mortgage rate to what you pay on your credit card. This chart shows a really fascinating shift. For a long time, the old rule of thumb was simple. When the Fed cut interest rates, that's the dotted line, you bought stocks, the solid line. When they raised rates, you sold, easy. But look at what starts happening after 1990. In 1994, the Fed starts hiking rates like crazy, but after a little dip, the market just soared. Same thing happened in 99. If you had just followed the Fed's lead, you would have missed out on massive gains. So why did the old wisdom just stop working? The answer really is that the market got smarter. Investors today are so hyper-focused on predicting what the Fed is going to do next that by the time a rate change is actually announced, it's already old news. The price is already baked into stocks. Trying to trade on the Fed's announcements became like betting on a horse race after it was already over. And all of this leads us to the central dilemma for every single investor out there. Section 5, Stocks versus Inflation. So, since we now live in an economy managed by the Fed, an economy that has persistent inflation, we have to ask the big question, are stocks actually a good way to protect your purchasing power?
For decades, this was just taken as a fact. But then, the high inflation 1970s came along and made everyone question everything they thought they knew.
This slide gives us the answer, and it all comes down to one thing: your time horizon. First, look at the chart on the left. This shows what happens over a 1-year period. It's a total mess. Stocks, bonds, bills, they're all terrible hedges. As inflation goes up, their real after-inflation returns just collapse. But now, look to the right. This tracks a 30-year holding period. The story completely flips on its head. Stocks deliver strong, stable, positive returns no matter what inflation's doing. Meanwhile, bonds and bills, they just get eaten alive.
So why are stocks so bad in the short term? Well, there are a few key reasons. First, when inflation rises, interest rates usually follow, and that makes boring old safe bonds look a lot more attractive compared to risky stocks. Second, inflation is often caused by things like oil crises, shocks to the system that directly hurt company profits. And finally, and this is a big one, the tax code is just brutal during inflation. It makes you pay taxes on gains that are purely from inflation, not from any real growth.
All right, let's bring this all home in our final section. Investing for the long run, the key takeaway. When you boil down all of this history, all of this data, you end up with a conclusion that's actually incredibly clear, and it's summarized perfectly right here. In the short run, if you get a surprise spike in inflation, well, pretty much nothing is a reliable hedge. But over the long run, only one of these financial assets has consistently protected and grown your purchasing power, and that's stocks. As you can see, bonds and cash just can't keep up over time. You know, the entire story of the last 100 years was really about this monumental shift from money backed by a shiny metal to money backed by governments. It created this world of constant, low-level inflation that we've all had to learn how to navigate. So that leaves us with one final big question to think about. What will the monetary system of the next 100 years look like? And how will investors have to adapt to it?
Have you ever seen this? The stock market is just hitting all-time highs, but the economy seems to be, falling apart. Or the reverse, where everything looks perfect and suddenly the market just crashes. It's seriously one of the most confusing things in all of finance. So today, we're going to untangle that very paradox.
So here's our game plan. First, we're going to tackle what I'm calling the Great Disconnect, why the market and the economy seem to live on different planets. Then we'll look into the market's crystal ball. Is it any good at seeing the future? After that, we'll meet the folks who officially call recessions, and you'll see why their timing is a bit of a problem. Then we'll dig into the data to decode the signals the market is really sending. We'll see why even the smartest experts get it wrong. And finally, we'll figure out what this whole mess means for you.
All right, let's dive right in. The central puzzle here is that disconnect. You see headlines about terrible unemployment numbers, but the S&P 500 is soaring. Or everyone's feeling good, jobs are plentiful, and then boom, the market suddenly tanks. Right? It feels like they're operating in two completely different universes. Let's find out why.
You know, the Nobel-winning economist Paul Samuelson absolutely nailed this paradox way back in 1966 with this legendary quote. What he's saying, in a nutshell, is that the stock market is a notorious drama queen. It is constantly panicking, it's constantly screaming that a recession is coming, when it just isn't. Basically, it cries wolf. A lot.
To really see this in action, let's jump in a time machine and go back to the summer of '87. The market was on an absolute tear, hitting record after record. But you know how it is? When things are that good, investors get nervous. They get antsy. So a bunch of them got together to hear from a top economist, hoping he could tell them everything was going to be okay.
And boy, did he deliver. The economist laid out this absolutely perfect forecast. He told them the economy was booming, corporate profits were set to soar, and there was absolutely positively no recession on the horizon for years. You can just imagine the sigh of relief in that room.
And here is the unbelievable part. The economist was 100% right. Every single one of his economic predictions came true. The economy did boom. But just a few weeks after that speech, the market experienced the infamous Black Monday crash of 1987, one of the worst single-day drops ever. And that right there is the lesson. A totally healthy economy does not guarantee a rising market. Not even close.
Okay, so if the market isn't a mirror of what's happening right now in the economy, then what is it? Well, the conventional wisdom is that it's a leading indicator. It doesn't really care about today's news. It's more like a giant collective betting machine that's trying to price in what the world will look like 6, 9, maybe 12 months from now.
And this chart really shows that relationship over, well, more than a century. Those gray bars you see, those are the official recessions. Now look really close to that black line, the S&P 500. See a pattern? Notice how it often peaks and starts to head down before a gray bar even begins. And just as important, look at how it often hits rock bottom and starts climbing back up while the economy is still deep inside one of those gray recessionary periods. It's like the market is trying to anticipate the turns.
But that begs the question, who actually decides when those gray bars start and end? It's not the government, actually. It's a private, nonprofit research group called the National Bureau of Economic Research, the NBER for short. And when you understand their process, you see a massive problem for investors.
So this right here is the NBER's formal definition of the business cycle. Think of them as the official scorekeepers. But, and this is crucial, their whole job is to look back at all the data and pinpoint the exact month that the economy peaked or bottomed out. That phrase, looking back, is the whole problem. And they don't use that simple rule of thumb you always hear about, 2 straight quarters of negative GDP growth. Nope, it's way more complicated. A special committee of economists sifts through a whole mountain of data, but they really focus on these 4 big areas to make their official call.
So here's the issue for anyone trying to make money. Their process is incredibly thorough, and because of that, it is incredibly slow. They care about being accurate, not fast. How slow, you ask? Well, for the recession that ended in March of 1991, they didn't get around to making the official announcement until 21 months later. By the time they tell you the recession is over, it's ancient history. Completely, totally useless for making investment decisions.
Okay, so clearly, waiting for the official call from the NBER is a total non-starter, which means we have to rely on the market's own signals. So let's dig into the hard data and see how good its track record really is.
So first things first, let's tackle the big one. How much of a heads up does the market actually give us before the economy officially rolls over and heads into a recession?
Okay, check this out. Here's the data for every post-war recession. Now, on average, the stock market peaks about 5.5 months before the economy does. And at first glance, you think, hey, that's pretty useful, but the devil is always in the details. Just look at the range here. Sometimes it gives you a whole 13-month heads up, but other times, like in 1980 and 1990, it gave 0 warning. None. The market peaked in the exact same month as the economy. That average number isn't just misleading, it's dangerous.
All right, so its record on predicting the top is, let's say, a little shaky. But what about calling the bottom? Is the market any better at signaling that a recovery is just around the corner?
Now this is where it gets really interesting. The data here is way more consistent. The market hits its bottom, on average, about 4.5 months before the economy officially does. And just look at how tight that range is. It's almost always between 4 and 6 months. It's like the market is a bloodhound that's much better at sniffing out the first signs of a recovery than it is at predicting the storm clouds of a recession. And this number right here, this is the multi-trillion-dollar takeaway. This is what it's all about. If you wait for the NBER to finally give the all clear, if you wait for the news headlines to finally turn positive, you have already missed a massive rally. On average, by the time the good news arrives, the market is already up almost 24% from its lows. You've missed the easiest, fastest gains of the entire recovery.
So the market seems pretty good, or at least consistent, at calling the bottom. But let's go back to that Samuelson quote from the beginning. Does the market ever predict recessions that just don't show up?
Oh, you better believe it. Here's a whole list of times the market plunged more than 10%, triggering all the panic and the recession is coming headlines, but no recession ever came. And hey, look who's back, our old friend, the 1987 crash. A terrifying 35% drop in the market that was a complete and total false alarm for the economy. Samuelson was right. The crystal ball isn't just cracked, it is a proven liar.
Okay, so the market is unreliable. But surely the brilliant economists at the big banks and the Federal Reserve, with all their fancy models, surely they can see these turns coming, right? Well, let's just say their track record is something else.
I mean, the history here is almost comical in how wrong they've been. In '74, they completely missed a severe recession. In '81, they're cheering for economic exuberance right before a disaster. In 1990, they're literally asking if the business cycle is dead, right as a worldwide recession is starting. And the grand finale. In December 2007, The very month the Great Recession officially began, the Federal Reserve itself went on record saying it saw no recession coming. The pattern is just undeniable. The experts are flying just as blind as the rest of us.
And all of this brings us to what we can call the investor's dilemma. We've got a market that sends mixed signals and experts who can't see the future. So what on earth are we supposed to do with all this information?
This right here is the heart of it. On one hand, you have the dream of market timing. The prize is enormous. I mean, can you imagine earning an extra 5% every single year just by knowing when to get in and when to get out? That's life-changing money. But on the other hand, you have the reality that we've just laid out. Predicting these economic turning points with any accuracy has been, for all practical purposes, impossible. And not just for us, but for Nobel Prize winners and the Federal Reserve.
So this brings us to the single most important lesson from all of this. The absolute worst thing an investor can do is react to the current economic mood. Because, as we've proven, by the time the economic news is good, the market is already taken off. And by the time the news is awful and everyone is panicking, the market is likely already bottomed out and is on its way back up. If you follow the headlines, you are almost guaranteed to buy high and sell low, every single time.
And so that really leaves us with one final, sobering thought. The data is crystal clear. The people who dedicate their entire lives to forecasting the economy consistently fail at its most crucial moments. So the question we all have to ask ourselves is this: if they can't do it, is that really a game any of us should be playing?
So here's a thought. You've probably been told that the stock market is rational. You know, some big news breaks and the market reacts in a logical way. But what if that's not the whole story? What if most of the time, the biggest, craziest swings in the market have almost nothing to do with the headlines you're reading? Today, we are diving deep into the real and often invisible forces that are actually driving the madness of crowds. You know, even a genius like Isaac Newton, a guy who literally figured out how the solar system works, was completely humbled by the stock market. He could map the stars, but the collective chaotic psychology of investors, that madness of crowds, it was a total mystery. And that's the exact puzzle we're going to try to piece together today, that huge gap between predictable events and totally unpredictable human reactions. To really get our heads around this, we have to go back to a day that truly changed everything. An event that seems like the clearest, most undeniable link you could ever find between a global tragedy and how the financial markets reacted. Picture this. It's the morning of September 11th, 2001. Traders are walking in expecting a totally quiet, maybe even boring day. There were no big economic reports on the docket. And then, at 8:48 a.m., the first reports start trickling in. In those first few moments, it was just chaos and confusion. Was it a terrible accident? A small private plane? Nobody had any idea. Okay, now look at this chart. This is the market trying to process the unthinkable, literally second by second. See the S&P 500 futures? At 8:48, you see that first little dip as the confusion hits. But then, look, it actually starts to recover. Traders are thinking maybe it was a tragic but isolated accident. And then, 9:03 a.m., the second plane hits. In that single instant, the story flips from accident to attack, and you can just see the market fall off a cliff. It absolutely plummets. It was psychology, not just information driving the car. And the fallout, man, it was immediate and it was everywhere. The U.S. markets just shut down for the longest time since the Great Depression. Over in Europe, the German market tanked more than 9%. And when the New York Stock Exchange finally opened its doors again on September 17th, the Dow had a truly historic drop of over 7%. By the end of that awful week, it was down more than 14%. So you look at all this and you think, okay, case closed, right? A horrific event caused a massive market crash. That story about 9/11 seems to lock in everything we think we know about how news affects the market. But here's where things get really interesting. What if that story, as clear-cut as it seems, is actually the exception? What if it's not the rule at all? Now we're going to completely challenge that core belief and look at the much, much bigger picture. I mean, based on what we just saw, the answer seems pretty obvious, doesn't it? Of course, big news causes big market swings. But what happens when you stop looking at one day and start looking at over 100 years of data? What does it actually say? Well, get ready for this, because this is probably the single most mind-blowing fact we're going to talk about. Less than 25%. Just let that sink in for a second. Looking at data all the way back to 1885,
That means that more than 3/4 of the biggest, most dramatic days in the stock market happened on days with no significant news to explain them. Nothing.
Now, just so we're all on the same page, what exactly is a major market move? We're talking about a day where the Dow Jones Industrial Average jumped up or down by 5% or more. Since 1885, that's only happened 145 times. And out of those 145 really earth-shaking days, we can only point to a clear headline for about 35 of them.
So that just begs the question, right? If it's not war or politics or some big disaster that's usually behind the wheel, then what on earth is moving the market? And for those few times when the news does cause a huge swing, what kind of headlines have the biggest impact?
Okay, so take a look at this table. It's pretty revealing. When you isolate just the big news-driven days, you start to see a really interesting pattern. It's not always war that's at the top. Notice how 4 of these 5 huge events are all about something called monetary policy. That's just a fancy way of saying decisions made by central banks about interest rates and the money supply. It's definitely not as dramatic as a war, but often it's way, way more powerful.
All right, let's wade into some tricky territory. Politics. It feels like everyone has a strong opinion on which political party is better for the stock market. But let's push the opinions aside and just look at the cold, hard data. So, on the left, you've got this very common perception, right? The idea that Wall Street generally prefers Republican presidents and their policies. But then you look at the reality. You look at the actual numbers since 1952, and whoa, the average annual stock return under Democratic presidents has been 14.2%. That's way higher than the 8.37% under Republicans. And just to be clear, we're not talking about some tiny statistical blip here. That is a huge performance gap over a 60-year period. Now, does this mean one party is magically better for the economy? Not necessarily. Correlation isn't causation. But it absolutely demolishes the conventional wisdom that so many people invest by. And when you zoom out and look at this really long-term chart, you can see it play out over time. The shaded parts are the Democratic terms. It's wild to see that the greatest bear market in American history happened under a Republican, Herbert Hoover, while some pretty incredible gains happened under Democrat FDR, even though Wall Street wasn't exactly his biggest fan club. Okay, so if it's not about donkeys versus elephants, what is it really about? Well, it boils down to one simple word: uncertainty. The market hates not knowing what comes next. When a president has a heart attack like Eisenhower or is assassinated like Kennedy, it creates this terrifying vacuum of leadership. The market drops because of that fear. But here's the key. These are almost always short-term shocks. As soon as things stabilize, the market tends to bounce right back. All right, now for the big one, war. The common thinking is pretty simple. War is bad, so stocks go down. But, you've probably guessed by now, the real story is way more complicated and surprising than that. Okay, this is where things get really sneaky and fascinating. If you just look at the surface level numbers, what we call nominal returns, stocks do about the same in wartime as they do in peacetime. But here's the catch: inflation. During wars, inflation has historically been about 3 times higher. So even if your stocks are going up, the value of your money is going down way faster. Your real return, what you can actually buy with your profits, is much, much lower. And get this, the market doesn't even treat all wars the same. When World War I started, there was total panic. The stock exchange actually closed for months. But by 1915, people realized the US was going to profit by supplying the war, and the Dow had its best year ever, up 82%. So when World War II came along, investors remembered that and caused a buying panic. But they got burned when the government slapped on an excess profits tax, and the market just fizzled out. Basically the same kind of event, but completely opposite reactions. In more recent conflicts, we've seen this same 3-step dance play out almost every time. Step 1, the initial shock. News of an invasion hits, and the market drops. But then comes step 2, a super fast reassessment. The market figures out who's likely to win incredibly quickly, sometimes in a matter of hours. And then comes step 3, the recovery. The market often starts to rebound long before the fighting actually stops. Okay, so we've picked apart politics, we've looked at war. What's the big takeaway here? After all of this, how are we supposed to think about the market and the constant barrage of world events? And it all comes back to this one simple chart. That huge slice of the pie, that 75%, that's the market moving for reasons that have nothing to do with what's on the front page of the newspaper.
It's driven by internal dynamics, by weird shifts in sentiment, by all the complicated human emotions that are really pulling the strings. And that really leads us to the most important thing to remember from all of this. World events can and absolutely do shock the market in the short run, but historically, they just haven't been able to put a permanent dent in the long-term growth that stocks have delivered over time. A crisis might knock the market down for a bit, but it has a really, really hard time keeping it down for good. Which brings us all the way back to Isaac Newton and his dilemma. The market isn't a clock, just ticking along predictably. It's a crowd, a messy, emotional, often irrational reflection of all our collective hopes and fears. And understanding that difference is maybe the most valuable insight any of us can have. So I'll leave you with the same puzzle that stumped one of the smartest people who ever lived. If it's not the news driving that 75%, what's really going on inside that madness of crowds?
Have you ever seen a headline, one of those big ones, shouting about how great the economy is doing, only to check your phone and see the stock market is absolutely tanking? It feels completely backward, doesn't it? Well, today we're going to unravel one of the biggest paradoxes on Wall Street, why fantastic news for the average person can sometimes be just awful news for the market. And believe me, understanding this little secret is going to change how you see the financial world forever. I love this quote from way back in 1966 because it just nails how messy and interconnected this all is. It's not one single thing that moves markets, right? It's this whole web of data, expectations, and, let's be honest, human emotions. Today, we're going to pull on one of the most confusing threads in that entire web.
So to really get a grip on this, we've got to go back in time. We're going to look at a specific moment when this exact paradox played out in, well, probably the most dramatic way you can imagine.
Okay, picture this. The date is July 5th, 1996. It's about 8:28 in the morning on a Friday, and it's sandwiched between the 4th of July holiday and the weekend. Now, normally, this would be a super quiet day on the street, but not this day. No way. Traders all over the world are just glued to their screens, waiting for the single most important economic number of the entire month. The tension is just thick. Then, at 8:30 a.m. on the dot, the news drops. And it is spectacular. I mean, just look at this. Payrolls have surged way more than anyone expected. Unemployment, it's at a 6-year low. And get this, wages are finally going up, posting the biggest jump in 30 years. Even President Clinton was out there calling it the most solid American economy in a generation. So this is amazing news, right? What could possibly go wrong?
Everything. Within seconds, and I mean literally seconds of this fantastic news hitting the wires, the markets just broke. European markets, which were already open, fell right off a cliff. The futures market for U.S. stocks went into a nosedive. In what felt like a blink of an eye, $200 billion in value was wiped out from global stock markets, and the bond market lost just as much. It was a tidal wave of selling, all because of great news.
So that brings us right to our big mystery. What on earth just happened? Why would news that screams prosperity and good times cause an all-out financial panic? Well, to find the answer, we have to learn the market's secret language.
All right, our first big clue is something that trips up almost everyone who's new to this. It's all about the game of expectations. You see, the market doesn't just react to the news itself, it reacts to how that news stacks up against what it was already thinking was going to happen. So here's how you have to think about it. Before any of these big reports come out, all the economists and analysts get together and form what's called a consensus estimate. It's basically their best guess, and that guess gets priced into stocks and bonds before the real number even comes out. So when the announcement finally happens, it's not the news itself that moves the market, it's the surprise, that gap between what everyone expected and what actually happened. A way stronger than expected report, like the one we saw, is what really sends the shockwaves.
Okay, so now we know the jobs report wasn't just good, it was a huge positive surprise. But why was that surprise a bad thing? This brings us to the main event, the real heart of the issue. This constant, epic tug of war going on inside the market between two super powerful and completely opposite forces.
This really breaks it down perfectly. On one side of the rope, you've got the bull. That's the optimistic force. A booming economy means companies are going to make more money, their profits will go up, and that should pull stock prices up. Great. But on the other side of the rope, you have the bear. That's the pessimistic force. An economy that's running too hot makes people worry about inflation. And what's the number one medicine for inflation? Higher interest rates, and that yanks stock prices down.
So, why exactly are higher interest rates the kryptonite for stocks? Well, imagine someone promised to give you $100, but you have to wait a whole year to get it. If interest rates are high, you could just stick, say, $95 in the bank today and it would grow to $100 in a year. See how that makes the promise of future money less valuable right now? A stock's price works kind of the same way. It's really just the value of all of its future profits added up and brought back to today's dollars. So a higher interest rate basically shrinks the value of all that future money. And when the economy is already humming along like it was in 1996, that fear of shrinking future value can easily overpower the promise of higher profits. Okay, so we've got this tug of war that's constantly being influenced by a whole flood of economic data. But which reports actually matter? I mean, what are traders actually looking at? Let's take a quick peek at a typical trader's watch list to see the data points that can move trillions of dollars in a single morning. Now, this might look like a total mess of information, but it's actually a highly choreographed dance. This is what a typical monthly calendar of economic releases looks like. Everything is scheduled way in advance, and see those little stars next to each report? That's its importance ranking. It tells traders which announcements have the real power to move markets. They basically live and die by this calendar, and the days that have 3 or 4 stars, well, that's when you can expect some fireworks. So the undisputed heavyweight champion of them all is the employment report. It comes out on the first Friday of every single month. And it's actually 2 different surveys rolled into one. The one traders are obsessed with is the payroll survey. That's where they ask companies, hey, how many people are on your payroll? The other one is the household survey, where they actually call up people at home and ask if they have a job. That's what gives us the headline unemployment rate. And because they're measuring 2 different things, businesses versus people, they can sometimes tell completely different stories about the economy. Next up, you've got the inflation reports. You have the Producer Price Index, or PPI, which is kind of like an early warning sign because it looks at wholesale prices. But the big one, the main event, is the Consumer Price Index, or CPI. That's the benchmark. Now, what's really crucial to know here is that traders, and especially the central banks, they fixate on something called the core rate. That version strips out food and energy prices because those things jump all over the place. What's left gives them a much better look at the true underlying trend of inflation. And finally, you have these forward-looking reports like the Purchasing Managers Index, or PMI. It's actually a pretty simple concept. It's a survey where they ask managers in the manufacturing sector if business is getting better or worse. But it's super powerful. A reading over 50 means the manufacturing part of the economy is growing. But if that number dips below 40, that's a huge red flag that a recession might be right around the corner. So we've got expectations, we've got this massive tug of war, and we've got a flood of data. But who's the final judge? Who decides which force wins? Who's looking at all this data and actually pulling the levers? Well, that brings us to the most powerful player in this entire game. Legendary investor Martin Zweig said it perfectly. At the end of the day, it all comes down to the central bank. In the US, that's the Federal Reserve, or the Fed. The Fed's policy on interest rates is the one dominant factor that can just steamroll everything else. All that economic data we just talked about, it's really just a bunch of clues trying to predict what the Fed might do next. And if you want a stunning example of that power, get this. On January 3rd, 2001, the Fed came out with a surprise interest rate cut. The market's reaction was instantaneous and absolutely explosive. The Nasdaq stock index rocketed up 14.2% in a single day. That's an all-time record. That right there is the raw brute force of monetary policy. So now, with all the pieces on the board, we can finally solve the mystery of July 5th, 1996. Let's walk through it. Step 1. The jobs report came in way hotter than expected. A huge positive surprise. Step 2. That massive jump in wages immediately triggered fears of runaway inflation. Step 3. Traders all came to the exact same conclusion in the exact same second. The Federal Reserve would have no choice but to slam on the brakes and raise interest rates to cool things down. And step 4, the sheer prospect of those higher rates meant the bearish force in our tug of war won a knockout victory, causing a massive panicked sell-off. Mystery solved. All right, so now that we've kind of cracked the code on this whole bizarre relationship, what does it all mean for you, as a regular investor? What's the practical lesson to take away from all this? Well, the first thing, and honestly the most important, is this. Trying to day trade or outguess the market's reaction to these monthly reports is an incredibly tough game. As we just saw, the reaction isn't as simple as good news or bad news. It's about surprises, inflation fears, and what the Fed might be thinking. It's basically a high-stakes poker game against the fastest computers and the smartest people on Wall Street. It's a game best left to the speculators.
So, while it's really fascinating to understand this short-term dance, trying to actually dance along with it is probably just a recipe for a lot of anxiety and mistakes. The much wiser path, for most of us anyway, is to just tune out that daily noise. A good, solid, long-term investment strategy is specifically designed to ride out this kind of short-term craziness, not react to every little headline.
But I'll leave you with this final thought. The next time you see a news story about the economy, you're going to see it through a totally new lens. You'll know it's not just about good versus bad. It's about expectations, it's about inflation, and it's about the massive shadow of the central bank hanging over everything. So now that you've learned a little bit of the market's secret language, are you ever going to listen to the financial news the same way again?
Welcome to The Explainer. Today, we're going to tackle 3 of the most powerful and honestly, most misunderstood tools in all of modern finance: ETFs, futures, and options. These are the instruments that have totally reshaped how money flows around the world.
But, let's start with a bit of a warning shot. Way back in 1989, you had investing legends like Peter Lynch and Warren Buffett who were, well, they were not fans. They basically saw these complicated new tools as a form of gambling. But fast forward to today, and their influence, it's just something you can't ignore. So to really get a feel for how big a deal these things have become, let me just ask you a quick question. If you had to guess, what was the single most traded U.S. security by dollar volume back in 2012? Think about it. Maybe a big tech name like Apple? Or, a massive oil giant like Exxon?
Well, the answer is probably going to surprise you. It wasn't a company at all. It was an exchange-traded fund, an ETF called SPDRs, which just tracks the S&P 500. And a staggering, get this, $7 trillion worth of this one fund changed hands that year. That's more than Apple, more than Exxon, more than any single company's stock out there.
Okay, so here's the plan. We're going to break it all down. We'll start with the market's biggest secret, ETFs. Then we'll dive into futures, then options. After that, we'll help you figure out which one might be right for you and wrap up with the financial revolution all this has created.
All right, first up, ETFs. Our source material calls this the single most successful financial innovation of the 1990s. And that's a pretty bold claim. Let's see why.
And when we say successful, we are not kidding. I mean, just look at this chart. The growth has been absolutely explosive. Those black bars are the ETFs. In just 10 years, from 2002 to 2012, the money in these funds grew 13-fold, topping $1.3 trillion. Just wow.
So what the heck is an ETF anyway? Well, the easiest way to picture it is kind of like a hybrid. It takes the best of 2 different worlds. On one hand, you get the broad diversification of a mutual fund, but on the other, you get the trading flexibility of a stock. You can buy it, sell it, all day long while the market's open.
Okay, so this is where the real magic happens. How does an ETF like SPDRs stick so perfectly to the S&P 500? It's all about a clever process called arbitrage. Basically, if the ETF's price ever drifts away from the real value of the stocks it holds, big financial players swoop in. They can buy the cheaper one and sell the more expensive one, making a tiny, risk-free profit. This constant buying and selling acts like a gravitational pull, snapping the ETF's price right back in line almost instantly.
And all this clever engineering gives ETFs some massive advantages over your old-school mutual funds. First, you can trade them anytime, not just once a day. You can even sell short if you think the market's headed for a downturn. And this is a big one. They are incredibly tax efficient. They almost never spit out the kind of taxable capital gains that can be a real headache with mutual funds.
Okay, so we've got ETFs down. Now let's move on to something even more powerful, an instrument that often acts like a sneak peek into the stock market's future. I'm talking about stock index futures. These things can give you a clue about where the market's heading before it even opens.
And to really get a handle on just how powerful they are, we got to go back to this really bizarre day in 1992. Picture this. A freak flood from the Chicago River suddenly knocks out power to the city's financial hub, forcing the huge futures exchanges to just shut down, right in the middle of the trading day.
Okay, check out this chart. That top line, that's the S&P 500 futures market. Buzzing along, super active, and then boom, around 11:45, it just dies, flatlines. Now look at the bottom line, that's the New York Stock Exchange. The exact moment Chicago went dark, New York just went quiet, eerily quiet. The source material says it's like the market just went brain dead.
And this just shows you,
plain as day how much Wall Street had come to rely on the signals coming out of Chicago. It's kind of funny, one market strategist at the time said the quiet was absolutely delightful, like a trip back to a simpler time. But what it really proved was that the futures market was where the real action was happening.
So, why all this influence? Well, it comes down to one hugely important word: leverage. Think about it this way. To buy a bunch of stocks, you usually have to put down 50% cash. But to control that exact same amount of stock value with a futures contract, you only need to put down about 5%. That's your margin, your good faith deposit.
Let that sink in for a second. For every $1 you put on the table, you can command about $20 worth of stock. It's incredible. But, and this is a huge but, it's a classic double-edged sword. That leverage can magnify your gains for sure, but it can magnify your losses just as fast.
Okay, so futures give you insane leverage, but also insane risk. So what if you want that power, but maybe with, I don't know, a safety net? Well, that brings us to our third and final instrument, options.
The beauty of an option is, well, it's right there in the name. It gives you the option. See, with a futures contract, you're obligated. You have to go through with the deal. But with an option, if things go south, you can just walk away. The most you can ever possibly lose is the money you paid for the option in the first place. That's it.
And they basically come in two flavors, calls and puts. Super simple. Calls give you the right to buy, so you'd use them if you think the market's going up. Puts give you the right to sell, which is your tool if you think the market's going to fall.
Okay, so let's recap. We've got ETFs, futures, options, and good old-fashioned index funds. They all let you tap into the market, but they're very different tools. So how on earth do you choose the right one for the job?
All right, let's just put them all side by side here. You can see right away, if you want to be able to trade all day long, ETFs and futures are your game. No contest. Need maximum leverage? Futures are the king of the hill. But, and this is a big one, look at tax efficiency. ETFs are just fantastic. Futures, on the other hand, are pretty terrible from a tax perspective.
So what's the bottom line for you? Well, futures are really the playground for hyperactive professional traders. But for most of us, for long-term investors, ETFs just hit that perfect sweet spot. They give you the best all-around mix of low costs, flexibility, and, most importantly, amazing tax efficiency.
And that brings us right back to where we started, doesn't it? With those warnings from legends like Lynch and Buffett. So after all this, were they right to be worried? Have these powerful tools actually helped or harmed investors in the long run?
Well, the author of our source material here lands on a pretty different conclusion. The argument is that, far from being dangerous, these products have actually been a huge net positive. They've made it cheaper and easier for everyone to diversify, they've added liquidity to the market, and they may have even helped push stock prices higher than they would have been otherwise. So this whole revolution, right, from the birth of index futures to the absolute explosion of ETFs, it really has been about giving more people more access to the market. And that leaves us with one last big question to chew on. If this is what the last few decades of financial innovation brought us, what in the world will the next generation of investment tools even look like?
You know, the term market volatility, it's enough to make your stomach drop, right? It conjures up images of flashing red screens and scary headlines. But is that all there is to it? What if inside all that chaos, there's actually a pattern, maybe even an opportunity? Today, we're going to unpack the two sides of market volatility. All right, let's just jump right in. I want you to take a really close look at these two charts. The one up top, that's the Dow Jones, leading right up to the infamous 1929 crash. The one on the bottom, the Dow just before the 1987 crash. I mean, look at them. The similarity is, it's uncanny. It's almost spooky. In fact, on the morning of the 1987 crash, the Wall Street Journal actually published a chart just like this one, pointing out the eerie parallel. They had no idea they were just hours away from it happening all over again. And this right here is the central mystery we're going to unravel. You have two market crashes that look almost identical on paper, and yet one of them threw the entire world into the Great Depression, the other, the market was hitting brand new highs in just 2 years. So how? How could you have such radically different endings? Well, that's the puzzle we're here to solve. So here's how we're going to tackle that puzzle. First, we'll get into that tale of two fates. Then, we're going to dissect the anatomy of a crash, look at our modern era of high-speed volatility, explore the all-important human factor, and finally, we'll wrap it all up to help you frame your own perspective. All right, let's start with that tale of two fates. How did these two seemingly twin events end up on such completely different paths? I mean, the contrast is just staggering. After 1929, the Dow didn't just fall, it was obliterated. It kicked off the worst bear market in American history, and it eventually lost almost 90% of its value. It was a genuine economic catastrophe. But after '87, a totally different story. The market was back and setting records in less than 2 years. So what was the secret ingredient? What changed? Well, the answer really comes down to one key player, the Federal Reserve. You see, by 1987, the Fed had learned the incredibly painful lessons from the 1930s. So this time, it acted, and it acted fast. It basically turned on a fire hose of money, publicly promised to support the financial system, and restored confidence. And what was the result? No bank runs, no credit freeze. The economy itself just kept chugging along. That one single institutional change, it made all the difference in the world.
Okay, so we know why the aftermaths were so different, but let's dig into the 1987 crash itself. To really get a handle on today's volatility, we first have to understand the mechanics of Black Monday. 22.6%. Just let that never sink in for a second. That's how much the Dow dropped in a single trading day. It is still the biggest one-day percentage loss in U.S. history. A drop like that today would wipe out trillions and trillions of dollars in wealth across the globe. It was a massive shock, and it was supercharged by a powerful new force in the markets.
And that new force was a brand new piece of technology called portfolio insurance. And you gotta love the name, right? It sounds so safe, so reassuring. It was a computer program designed to automatically protect big investment funds from losses by selling something else that was also pretty new, stock index futures. And the idea, on paper, was actually pretty clever. So you're a big fund. You hold a ton of stock. If the market starts to fall and hits a certain point, bam, a computer program automatically sells futures contracts to cancel out your losses. In theory, it was this perfect automated shield, kind of like a stop-loss order on steroids. But here it is. This is the fatal flaw in the whole system. Portfolio insurance was built on one huge assumption, that there would always be someone on the other side of the trade willing to buy. But on October 19th, 1987, all of these computers, all running the same smart program, tried to sell at the exact same time. The buyers just disappeared. It created this terrifying waterfall effect where selling just created more selling, and the whole system was overwhelmed.
Now, portfolio insurance itself is basically ancient history, but the dynamic it unleashed, this idea of automated trading creating dangerous feedback loops, well, that has only gotten faster and more powerful. And that brings us right into the modern era of volatility.
And if you want proof, look no further than the flash crash on May 6th, 2010. I mean, look at this chart. If Black Monday was a slow-motion car crash that took all day, this was its high-speed sequel. It happened in minutes. On a day with no real news, the bottom just fell out of the market, and then it snapped right back almost as quickly.
The chaos inside the market was even more bizarre. I mean, get this. A giant firm like Accenture went from trading at around $38 a share all the way down to a single penny. A stable blue-chip company like Procter & Gamble got cut in half. We're talking $800 billion in value just vanishing in about 5 minutes. It was Black Monday on hyperspeed, a battle between computer algorithms that just ran out of humans.
But as shocking as all this is, it's really important to take a step back and zoom way out. This chart shows market volatility going all the way back to the 1830s. And the big takeaway here is pretty clear. If you take out that extreme spike during the Great Depression, these ups and downs have been a surprisingly stable part of the market for almost 200 years. Volatility isn't some new computer glitch. It's a timeless, built-in feature of the system.
And today, we can actually measure all this anxiety in real time. We use something called the VIX, but pretty much everyone just calls it the fear index. It tracks what the market thinks volatility is going to be in the near future. But here's the wild, counterintuitive part. Look at where the VIX spikes the highest, in '87, in 2008. They line up almost perfectly with the exact bottom of the market. The moment of maximum fear has often been the moment of maximum opportunity.
Because you see, technology might make the crash happen faster, but it doesn't create the underlying panic. For that,
We have to look at the oldest, most predictable part of the system, the human factor. The famous economist John Maynard Keynes absolutely nailed this dilemma decades ago. What he's basically saying here is that trying to figure out what something is actually worth can feel a lot riskier than just trying to guess what everyone else is going to do next. This creates this powerful incentive to just follow the herd, especially when that herd is stampeding toward the exit. And yet, here's the other side of that coin. This quote is from a memo written in May 1932. This is the absolute bottom of the barrel of the Great Depression. The market has been destroyed, and someone had the clarity to write that in a few years, people would look back at these prices as ridiculously cheap. And you know what? 2 months later, the market hit its final bottom and started the long, slow climb back. It's an incredible example of seeing past the panic.
So all of this leads us to the most important question of all. What about your perspective? How do we take all these lessons and learn to see not just the danger in volatility, but maybe even the opportunity?
Well, first, it is important to know that the system today has some new safety valves. We now have things like market-wide circuit breakers. Basically, if the market drops too far too fast, trading just stops. Everything is halted for 15 minutes. The whole point is to hit the pause button on the machines and give the humans in the system a moment to breathe, think, and maybe break that panic cycle.
But ultimately, navigating all of this really comes down to which of these two mindsets you decide to adopt. There's the panic mindset, right? That's focusing on every little price change, following the crowd, seeing only danger and overreacting. But then there's the perspective mindset. This one is armed with history. It focuses on long-term value, acts independently, and understands that moments of widespread fear can also be moments of great potential.
Because look, if there's one thing that's for sure, it's that the future will always be uncertain and markets will always be volatile. History has shown us again and again that real opportunities are often found by those who are willing to be calm when everyone else is panicking. So the final question isn't if the next crisis will come, it's when it does. What will you see? Danger or opportunity?
Welcome to The Explainer. Today, we're diving headfirst into one of the oldest and, let's be honest, one of the most heated debates on Wall Street: technical analysis. So, is it some kind of secret code to riches? Or is it basically just reading tea leaves? Let's dig into the data and see what we find.
You know, to really set the stage, let's go way, way back. This is a quote from Benjamin Graham and David Dodd, two absolute legends of investing. And they wrote this in 1934. They're saying that even back then, people were looking at chart readers and thinking, is this investing or is this some kind of magic trick? It perfectly frames the fight that's still going on today.
When you really boil it down, the world of stock picking is dominated by two major tribes. You've got one camp that lives and breathes spreadsheets and financial reports, and then you have the other camp who are just glued to their screens, searching for hidden messages in the zigzags of a price chart.
Now here's the real difference between them. On one side, you've got fundamental analysis. Think of these folks as business detectives. They're digging into a company's health. What are its earnings? Does it pay a dividend? How much is it really worth? On the other side, you've got the technical analysts, the chartists. They couldn't care less about earnings reports. They believe that everything, all the news, all the hope, all the fear is already cooked into the price. For them, it's all about patterns because they believe human psychology makes history repeat itself.
Okay, so let's try to see the world through a chartist's eyes for a minute. We're going to dive into their world of head and shoulders patterns, flags, pennants. I mean, it's a whole different language. But why? Why are they so convinced that these shapes on a screen can predict the future?
So here's the absolute key idea for a technical analyst. It does not matter why a stock is moving. A company could have found the cure for cancer. It doesn't matter. They argue that all that information gets instantly baked into the price. So their job isn't to figure out the why, it's to study the how. How is the price moving, and what does that movement tell us about what's coming next?
And listen, this isn't some newfangled idea. We're talking about Charles Dow himself, the guy who co-founded the Wall Street Journal and literally created the Dow Jones Industrial Average. He had this really beautiful way of looking at it. He said the market moves like the ocean. You have the main tide, which is the big long-term trend. Then you have the waves, which are the corrections along the way. And finally, you have the little ripples. That's just the day-to-day noise.
Okay, but now let's flip the coin. Because for decades, academics and economists have been pushing a very powerful, very simple counterargument. And it's one that throws a massive wrench in the works for the chartists. What if all those patterns they see aren't really there at all? What if it's all just an illusion?
This is the famous random walk theory, and it's the bedrock of what's called the efficient market hypothesis. The logic goes like this. If a market is efficient, all the old news is already in the price. So the only thing that can possibly make a stock move is new news, a surprise. And what's the one thing we know about surprises? Well, by definition, they're unpredictable, they're random. So stock price movements must be random too.
So, if that theory is true, a real stock chart should look no different than a chart we made up by just flipping a coin over and over again. Heads it goes up, tails it goes down. So how about we put that to the test? On the next slide, you're going to see 8 different charts. 4 are the real Dow Jones. The other 4 are totally random. You think you can tell which is which?
Okay, take a good look. I mean, some of these look like they have real trends, right? Some have scary-looking drops. A chartist would probably see all sorts of signals in here. But remember the theory. Half of these are pure, meaningless, computer-generated noise. Can you spot the fakes? All right, drum roll, please. How'd you do? The real ones were B, D, E, and H. Now, if you found that hard, hey, you're in good company. When researchers did this with actual Wall Street pros, they couldn't tell the difference either. The only one they could consistently pick out was chart D, and that's only because it shows the historic one-day market crash in 1987. That's a pretty powerful point for the random walk camp, don't you think? So the academics seem to have a pretty strong case, right? But, and this is a big but, there's one super simple technical strategy that has been around forever and just refuses to die. So let's forget the theory for a second and just look at the real-world numbers. How does this thing actually perform?
We're talking about the 200-day moving average. And it's exactly what it sounds like. It's just a line that shows you the average price over the last 200 trading days. The whole idea is to smooth out all that daily noise, all those ripples Charles Dow talked about, so you can clearly see the underlying tide. Is the long-term trend up or is it down?
And the trading rule that goes with it is dead simple. It's totally mechanical, there's no emotion involved. Here it is. When the market closes more than 1% above that long-term average line, you buy. That's a sign of strength. And when it closes more than 1% below the line, you sell and move to safety. That's a sign of weakness. That little 1% buffer is just to keep you from trading on every tiny little wiggle. And this chart right here, this is the strategy's greatest hit. This is its claim to fame. Look at the 1929 market crash. The rule kept you invested all through the roaring 20s, and then, and this is incredible, it flashed a sell signal just 10 days before the great crash. And then it kept you safely out of the market during the absolute worst of the downturn. I mean, that is amazing.
Wow. I mean, that's a dramatic success story. But one great call could just be a fluke, right? So the real question is, does this simple little rule actually work over the long haul? Well, some researchers went back and crunched the numbers on the Dow for over 100 years. And the results? They're pretty surprising.
So, at first glance, hey, it's a win for the chartists. Over 126 years, the timing strategy actually beat a simple buy and hold strategy. Not by a ton, but it came in at 9.73% a year versus 9.39%. And over that long, that little bit adds up to a lot of money. But do you see that huge asterisk there? No costs.
And this, my friends, is the catch. This is where it all changes. Because in the real world, every time you buy and every time you sell, you have to pay the piper. There are commissions, there are taxes. And once you factor in those real-world costs, the timing strategy's return plummets down to 8.11%. And just like that, simple buy and hold is the winner again.
So what's going on here? Well, the problem is this nasty little thing called whipsawing. See, the strategy is awesome when the market is making a huge move up or a huge move down. But when the market just goes sideways chopping around, it gets killed. The market pops above the line, you buy. A week later, it dips below, you sell. Then it's back up, you buy again. All that trading just racks up costs and tiny little losses that bleed you dry.
Okay, so if it doesn't actually make you more money after costs, then why on earth is it still so popular? And that brings us to its real benefit. It's not about boosting your returns. It's about reducing your risk. Because this strategy gets you out of the market during those catastrophic crashes, its overall volatility is about 25% lower than just buying and holding.
And this chart just lays it out perfectly. Look way over on the left side. See those horrible, gut-wrenching years where buy and hold lost 30, 40, even 50%? The timing strategy completely avoids those. It dodges the bullet. But nothing in life is free, right? The price you pay is that you have more of those small, annoying losing years. Those years where you lose maybe 5%. It's basically like buying insurance. You pay a small premium to make sure your house doesn't burn down.
So this leaves us with a really fascinating puzzle, doesn't it? The smartest people in academia tell us that the theory behind this is all an illusion. It's just a random walk. And yet here's a simple rule based on that so-called illusion that is proven over a century of data to provide a very real benefit. It lowers your risk. So what's an investor supposed to do?
You have the hardliners, like the famous economist Burton Malkiel, who are completely unconvinced. His verdict is absolutely brutal. He says the whole thing is false, and all you're doing is making your broker rich. And you know what? When you look at those after-cost returns, he's got a pretty strong point.
But that brings us right to our final, and I think most important question. On the one hand, you have an elegant academic theory that says this shouldn't work. On the other, you have a practical rule that while it doesn't make you richer, does demonstrably make the ride smoother and less scary. So we'll leave you with this to think about. In the real world of investing, what matters more? Having a theory that is intellectually pure and correct, or using a tool that gives you a practical, useful result, even if nobody can quite agree on why?
All right, let's jump right in. What if I told you that one of the most powerful tools for trying to understand the stock market wasn't some crazy complex algorithm, but just a simple calendar? I know, it sounds almost too easy to be real, but for decades there have been these strange, predictable patterns tied to specific months, weeks, and even certain days of the week.
Of course, Mark Twain was joking here. He was pointing out that trying to speculate in stocks is pretty much always a dangerous game. But his joke really gets at the suspicion that investors have had forever, that time itself, the simple passing of days and months, seems to play a really weird role in how the market behaves.
And that really brings us to the big question for this whole explainer. Can these so-called calendar anomalies actually give you a real edge? I mean, is it possible that when you invest could be just as important as what you invest in? Let's dig in and find out.
So, to get started, we've got to understand what we're actually looking for here. These aren't just random one-off flukes. We're talking about persistent, documented patterns that, for a very long time, seemed like a kind of hidden code buried deep inside the market's chaos.
The key word for us today is anomaly. In the world of finance, an anomaly is a predictable pattern that, honestly, just shouldn't exist. It flies in the face of what's called the efficient market hypothesis. That's the big theory that says all known information is already baked into stock prices, which should make them totally unpredictable. Well, calendar anomalies are a huge challenge to that idea.
And there is no bigger challenge to that theory, no bigger anomaly of them all, than the granddaddy of them all, the famous January effect. For most of the 20th century, this was, without a doubt, the most powerful and reliable pattern in the entire stock market.
Now, I want you to take a second and really look at this chart, because what you're seeing is pretty astonishing. That top line shows the incredible growth of small-cap stocks over a long period. But now look down at the other line. That's what happens to the exact same stocks if you just take out their performance in January. It's wild. Almost all of their famous outperformance happened in just the first 31 days of the year.
To really understand the sheer power of what we're talking about, let's put it in dollar terms. Imagine you invested just $1 back in 1926. And your strategy was simple. You buy small stocks for January, and then you just switch over to large stocks for the rest of the year. By 2012, your single dollar would have turned into a whopping $75,020.
Okay, but now for the flip side. Get this. If you had invested that same dollar in the very same small stocks, but you decided to sit out every January, you just removed that one powerful month, your investment would have grown to only $469. I mean, think about that difference. It's the same stocks, the same time period. The only thing that changed was 1 month.
This effect was so strong, so resilient, that it actually worked during the absolute mayhem of the Great Depression. While the whole market was just collapsing, an investor could have actually made 50% profit just by buying small stocks for the month of January. It's just incredible to think about.
So what on earth was going on? Well, the leading theory has always been something called tax loss selling. The idea is that investors would sell their losing small stocks in December to get a tax deduction, pushing prices down. Then, come January, everything would snap back. All those year-end bonuses getting invested probably played a part too. But here's the curveball. This was also happening in other countries, like Japan and Canada, even in places that didn't have the same tax laws. That suggests something else, maybe something psychological was going on.
Okay, let's pivot from the best of times to, well, the absolute worst of times.
if January was the market's golden child, then September has historically been its curse. It is, by a pretty wide margin, the single worst performing month of the entire year.
And this chart just lays it all out there. That dotted line at the top, that's the steady growth of the Dow Jones over time. The solid gray line right above it shows how much better you would have done if you just took a vacation from the market every September. And that grim downward sloping line at the bottom, that's what would happen if you only invested during September. It's just a long, slow road to ruin.
Let's put that into perspective. $1 invested in the Dow over that whole 127-year stretch grew to $511. Pretty good. But if you had just stayed out of the market every single September, that same dollar would have grown to over $2,200. That's more than 4 times the return, just for avoiding one lousy month.
And just like the January effect, this wasn't just some weird American thing. This slide shows that from 1970 to 2012, September had negative average returns in every single one of the 20 developed countries they looked at. It's a truly global pattern, and it's puzzled researchers for years.
So why is September so bad? Honestly, the reasons are pretty speculative. Some people think it's because investors are selling stocks to pay off their summer vacation bills. Others point to psychological stuff. The days are getting shorter, summer's over, and it just impacts everyone's mood. My favorite theory, though, is that it's the monthly Monday, just this collective, market-wide dread of getting back to business. But really, nobody knows for sure.
Now, after seeing all this powerful historical data, you might be tempted to cook up a trading strategy around it. But here comes the big twist in our story. You'd be forgetting one of the most important rules of the market. It adapts.
That's right, the January effect. The most famous, the most powerful anomaly of them all. It's basically gone. It's vanished. So why? Well, because once a pattern like this becomes common knowledge, smart traders try to profit from it. They start buying in December to get ahead of the January pop, and when they do that, they smooth the whole thing out. They arbitrage the anomaly away. And this table is the perfect illustration of how dramatically things can change. For decades, Monday was by far the worst day of the week to own stocks, and Friday was the best. But look at what happens in the more recent period. The entire pattern completely reverses. Monday becomes a positive day, and Friday actually turns slightly negative. It's wild.
And that's not the only one. There was another famous pattern, the super strong returns you used to see on the very last trading day of the year. That's also flipped and turned negative in recent decades. The market learned the pattern, and it changed its behavior.
So after all this, after seeing these really powerful patterns just appear and then, poof, fade away, what's the real takeaway for an investor today? Are these calendar effects just interesting history lessons, or is there still some value here?
So what does this all mean for you? Well, look, building your entire strategy around these things is probably a really bad idea. Like we've seen, they can just disappear. And things like transaction costs and taxes can eat up any tiny edge you think you have. But some patterns, like September being a generally weak month, have been surprisingly sticky. So maybe the best way to think about it is using this knowledge on the margins. If you were already planning to buy some stock, maybe waiting for a historically weak period like early September could make sense. It's more about timing a decision you were already going to make, not making the decision because of the calendar.
And that kind of leaves us with one last big thought to chew on. The market is like a living, breathing thing. It adapts. And as it learns and erases these old, well-known patterns, the behavior of millions of investors is, without a doubt, creating new, more subtle patterns that we probably haven't even found yet. The real question is, what are they? And how long will they last before they also become ghosts of the past?
When you think about investing, you probably picture a lot of charts, data, and really complicated spreadsheets, right? But what if I told you that the single biggest risk to your portfolio isn't some market crash or a bad economic report, but what's going on inside your own head? Today, we're diving into behavioral finance and the absolutely fascinating and often really costly ways our own psychology can be our worst enemy as investors.
This quote from way back in 1930 just feels so wrong, doesn't it? It goes against every single one of our instincts. I mean, our gut screams at us to buy when everything's going up and to sell, to get out when things look scary. But as we're about to see, learning to fight that exact instinct is pretty much the central battle every single investor has to fight. So let's figure out why.
To really see these psychological traps in action, let's meet an investor. We'll call him Dave.
His story is set during the dot-com bubble of the late 90s, and honestly, it's a perfect case study of just how easily our emotions can lead us down the wrong path. And as we follow his journey, you might just see a little bit of yourself in his story.
And wow, this timeline just shows how fast a dream can turn into an absolute nightmare. It all starts with the classic case of FOMO, that fear of missing out, as Dave jumps headfirst into the internet craze. And at first it works. He's up 60%, he feels like a genius, and he starts trading more and more. Even as things start to go south, he thinks he's making a smart move, shifting to the safer, big-name tech companies. But then comes the classic trap. Instead of cutting his losses, he doubles down, trying to average down. And by the end, this whole chain of what felt like logical decisions at the time has completely wrecked his portfolio.
This is rock bottom. This is the moment of total despair for Dave. He did everything he thought you were supposed to do, right? He followed the news, he listened to the experts, and he still ended up buying at the top and selling near the bottom. He is completely lost. So his wife urges him to get help, and this really brings us to the core of our story. See, it wasn't the stocks that were the problem. It was his psychology. So let's break down exactly what went wrong inside his head.
All right, so the first major force that got Dave into trouble is one of the most powerful instincts we have as human beings, the need to follow the crowd. When literally everyone around you is doing something and seems to be getting rich from it, it is incredibly hard to be the one person who stands on the sidelines.
And this, right here, perfectly describes what was happening to Dave. He was completely caught up in the pull of the herd. All his friends were making a killing, the news was buzzing 24/7 about this new economy, and that fear of being the only one left behind was just overwhelming. It's this powerful, almost primal urge we have to follow the crowd, even when that crowd is heading straight for a cliff.
And get this is not a new thing. Charles Mackay wrote about this way back in 1852. He was writing about financial manias that happened centuries before him. The technology changes, the stocks change, but the pattern is always the same. A whole group of people gets obsessed with one idea, and all rational thought just goes right out the window. Dave wasn't the first, and he certainly won't be the last. Economists actually have a great term for this phenomenon. It's called an information cascade. And here's a super simple way to think about it. Picture this. You're in a new town, you're hungry, and you see two restaurants side by side. One is packed with people, and the other is totally empty. Which one do you choose? Well, you're probably going to pick the busy one, right? You just assume the crowd knows something you don't. But here's the thing. Your choice makes that crowd even bigger, which makes it even more likely the next person will also choose it. That is exactly what happens in financial markets. A hot stock gets a little attention, which draws in more people, which gets it more attention, and pretty soon you have a full-blown mania that has nothing to do with the company's real value. So that's the herd instinct. But the second major flaw that tripped Dave up was his own confidence. When his first few investments shot up, he didn't think, wow, I got lucky in a bubble. Nope, he thought, wow, I am a brilliant trader. And that overconfidence, that led him straight to his next big mistake.
You know, this brings up a really interesting question. When you're feeling confident, when you feel like you have an edge, does trading more often actually help you get better results? I mean, it feels like it should, right? You're being active, you're responding to the news. But the actual data on this is, well, it's pretty stunning.
Negative 7.1%. This number comes from a huge landmark study that looked at thousands and thousands of real brokerage accounts. And what it found was that the investors who traded the most, they didn't do better, they did dramatically worse. They underperformed the overall market by a staggering 7.1% every single year. Just let that sink in. All that effort, all that confidence, all that clicking buy and sell, it was all actively destroying their own wealth.
So where does this dangerous overconfidence even come from? Well, it's usually a cocktail of a few key biases. First up is self-attribution bias. That's when we take all the credit for the good stuff. When Dave's portfolio went up 60%, he didn't think the bubble, he thought, I'm a genius. Then there's representative bias. This is when we get sucked in by a really good story. Dave's broker told him buying Cisco was like selling pickaxes during the gold rush. It's a great story, but it's a terrible analogy that made him feel way too safe. And finally, you've got cognitive dissonance. This is basically our brain's defense mechanism to ignore any information that contradicts what we already want to believe. As tech stocks started to fall, Dave just tuned out the bad news, because admitting he might be wrong was just too painful.
And now we get to what is maybe the single most powerful and destructive emotion in all of investing, the deep, profound pain of admitting you were wrong and actually taking a loss.
This fear completely warps our thinking in ways that are both predictable and incredibly costly.
It all comes down to this core idea called loss aversion. Some really groundbreaking research showed that for our brains, the psychological pain of losing, say, $1,000 is roughly twice as intense as the pleasure of gaining that same $1,000. Now, that's not rational at all, but that's just how we're wired. And it's this intense fear of making a loss real that forced Dave to just cling to his falling stocks, desperately hoping they just please get back to even.
And this one bias kicks off a whole chain reaction of terrible behaviors. First, you get anchoring. Dave was anchored to the high price he paid for his stock. He thought $40 was a bargain just because it used to be $80. Then comes get-even-itis, which is exactly what he did. He bought more of a losing stock in a desperate attempt to get his average cost down so he could just get out at break even. And finally, there's the disposition effect, which is this weird tendency we have to sell our winners way too early to lock in a small gain while we let our losers run and run, hoping they'll come back. Okay, this slide really gets to the heart of a huge trading paradox. It is so tempting to think that having a high win rate is the goal, but look at the unsuccessful trader. They're right 80% of the time, but they take these tiny little wins and then a few huge losses just sink their entire portfolio. Now look at the successful trader. They're actually wrong most of the time, but they make money because they are incredibly disciplined. They cut their losses super quickly and they let their few big winners grow into massive home runs. The key takeaway here is huge. Your success isn't determined by how often you're right, it's determined by how much you make when you're right versus how much you lose when you're wrong.
All right, so we spent all this time diagnosing the problems, right? We've got herding, we've got overconfidence, we've got loss aversion. But the big question is, how do we fight back against our own worst instincts? Well, the answer isn't to become some kind of emotionless robot. It's to build a disciplined system that can protect us from ourselves when we're at our most emotional.
So how can you build that discipline? Here are 4 really practical rules. Number 1, pre-commitment. This just means you decide on your long-term plan when you're calm and rational, and you actually write it down. That way, you have a rule book to follow when your emotions are running high. Number 2, set sell points. If you're going to trade individual stocks, decide your absolute exit price before you even buy. This takes that agonizing decision of should I sell now completely out of your hands. Number 3, use a play account. Look, if you love the thrill of picking stocks, that's fine. Just do it in a small, separate account, money that you can truly afford to lose, and keep it far away from your serious retirement funds. And finally, number 4 is the easiest and maybe the most effective. Just look less often. Staring at the market ticker every day is a recipe for anxiety and bad short-term decisions. Check in less often, and you'll be way more likely to stick with your long-term plan.
Now, the ultimate antidote to that herding instinct we started with is to actively practice thinking in the opposite direction of the crowd. This is the whole idea behind contrarian investing. Just like Humphrey Neal said, when an idea becomes super popular in the market, when everyone agrees on it, that's often a sign that it's reached its peak and it's about to turn. The biggest opportunities are usually found where nobody else is even looking.
And if you want stone-cold proof that this contrarian idea works, just look at this chart. It's incredible. It tracks how optimistic or pessimistic investors are feeling about the market. Now just look at the lowest points on this graph, the troughs. The 1987 crash, the dot-com bust, the 2008 financial crisis. These were the moments of what they call maximum pessimism, when people were absolutely terrified. And what happened next? Every single one of them in hindsight was a brilliant, once-in-a-decade opportunity to buy. It brings us right back to that quote from the very beginning. The market is most inviting when it looks its absolute worst.
And that brings us to our final thought. This old Wall Street saying just sums it all up perfectly. Investing is so much more than just numbers on a screen. It's a journey of self-discovery. The market will find and expose every single one of your psychological weaknesses, your fear, your greed, your ego, your pride. To succeed, it's not enough to know the market, you have to know yourself. And the real question is, how much are you willing to pay for that lesson?
So, beating the market, right? It's like the holy grail of Wall Street, this constant, high-stakes race to pick the next winning stock. But what if I told you it's a game that, for most people, is almost impossible to win? We're going to dive in, because the data, it tells a really surprising story about why this race might be rigged right from the start.
You know, this quote right here from Charles Ellis, written way back in 1975, it just hits the nail on the head. It perfectly frames the giant paradox we're exploring. I mean, think about it. If the biggest players, the giant funds, the professionals, if they are the market, who exactly are they supposed to be beating? Each other? It's a fantastic question, and it's the key to this whole puzzle.
Okay, so there's this classic Wall Street story that gets this point across perfectly. You've got 2 fund managers, they're out camping, and suddenly this huge grizzly bear wanders into their campsite.
One of the managers, without missing a beat, sits down and starts lacing up his running shoes. The other one looks at him, totally baffled, and says, "What are you doing? There's no way you can outrun a bear." And the first manager just calmly replies, "I don't have to outrun the bear. I just have to outrun you." And that right there is the whole mindset. It's not about winning in an absolute sense. It's just about beating the other guy.
All right, so here's what we've got on tap. First, we're going to break down why this is the race you can't win. Then we'll get into the hard numbers because the evidence is in. After that, we'll ask the big question. Are the winners just lucky, or is it real skill, luck, or hype? Then we'll get to the solution, which is, funnily enough, winning by not playing. And finally, we'll look at a really cool upgrade called a better way to index. Okay, let's kick things off with a really simple but absolutely crucial idea. The total return of the entire stock market is just the average return of every single dollar that's invested in it. That sounds obvious, right? But that simple fact sets up a very particular kind of game. What it creates is a zero-sum game, but with a catch. It's a zero-sum game before costs. And that before cost part, oh, that is huge. We're going to circle back to that for sure. But just let the basic idea sink in. For every single dollar that makes a profit above the market average, some other dollar, somewhere, has to lose that exact same amount. It is just math. You can't have a classroom where every single kid is above average, right? Somebody has to be in the bottom half.
All right, so the theory, it sounds pretty rough for the professional stock pickers. But, theory is one thing. What is the actual data, the hard evidence from decades of performance? Tell us, have the pros, the people getting paid the big bucks to do this, actually pulled it off?
Okay, take a look at these numbers. This is where it gets really, really interesting. This data covers more than 40 years. The top line, all funds, shows the average mutual fund returned 9.23% a year. But the market itself, it returned 10.23%. That means, on average, the pros were lagging behind by almost a full percent every single year. Before costs, they were the market. But after you factor in their fees, well, they did worse.
And if you thought that was bad, wait till you hear this. There's this little thing called survivorship bias that makes the real picture even grimmer. See, when we look at these long-term studies, we're only seeing the funds that are still around, the survivors. What we don't see are the thousands of funds that did so badly they had to shut down. They just vanished from the records, which makes the average performance of the funds left standing look way better than it actually was.
This chart, wow, this just lays out the struggle year by year, plain as day. See that solid line going across the middle? That's the 50% mark. Any year a bar is below that line, it means most of the pros lost to the market. Now just look, especially in the later years here, it's just a sea of red bars below that line. Out of the last 25 years shown, a majority of funds managed to beat the market in only 6 of them. The market is just consistently winning.
Okay, now this is fascinating. This chart looks only at the winners, right? The funds that actually survived for the entire 40-year period. These are the best of the best. And even in this super elite club, less than half, only 38 out of 86, could actually beat the market. And look at the spread. A lot of the losers lost big, while a bunch of the winners barely scraped by with a tiny victory. The odds are just not good.
Okay, so we've established the average fund manager doesn't beat the average. But what about the superstars, the legends, the Peter Lynches, the Warren Buffetts of the world? Are they just incredibly lucky people who won the lottery? Or is there some genuine repeatable skill there that we could try to find in the next manager?
1 in 500,000. Yeah, those are the odds that Peter Lynch's insane performance at his Magellan Fund, beating the market by 13% a year, was just pure luck. The chances are so tiny, it's pretty safe to say we're talking about real skill. So genius is real. It definitely exists. But man, is it rare.
But, and this is a huge but, even if you find one of these geniuses, it's still not a sure thing. This table is wild. It basically says that even if your manager has a genuine, real skill advantage of 2% a year, there's still a 26% chance, that's more than 1 in 4, that they'll actually be losing to the market after a whole decade, just because of a string of bad luck. Proving skill takes a long, long time.
And that leads us perfectly to the whole hot hands idea. And boy, is there a story for this. The poster child was a guy named Bill Miller. He beat the S&P 500 for 15 years straight. Can you imagine? From 1991 to 2005?
The guy was a living legend, the definition of skill. And then, bam, the hot streak went ice cold. It's just a brutal reminder that a spectacular track record is absolutely no guarantee of what's coming next. So, if trying to find the next superstar manager is basically a needle in a haystack situation, and even then it's not a sure bet, what do? How do you win? Well, funny enough, the most effective strategy is to win by deciding not to play their game at all.
And here's the real secret, the thing we hinted at earlier. The reason most funds lose isn't because they're bad at picking stocks. Nope, on average, their picks are, well, average. The real enemy? The true performance killer? It's the costs. You've got the fees you pay the manager, you've got the commissions on all their trades, and you've got these little hidden costs called bid-ask spreads. It's a constant, steady drain on your money.
And if you want to see just how much those tiny-sounding fees can gut your returns, just look at this. You start with $1,000, the market does its thing for 30 years, and you end up with about $23,000. Not bad, but a 1% annual fee shaves that all the way down to $17,000. And a 3% fee? You're left with just 10 grand. You've lost more than half of your potential gains to fees. It's absolutely brutal.
So this guy, this absolute visionary named John Bogle, he saw this whole problem clear as day. And back in 1976, he had a crazy simple idea. If you can't beat the market and costs are the enemy, then just own the market and do it as cheaply as possible. Wall Street literally laughed at him. His first index fund was called Bogle's Folly. But look what happened. The idea slowly, then very quickly took off, and it completely changed how people invest.
Okay, so you might be thinking, great, problem solved. Just buy a cheap S&P 500 index fund and call it a day. And for a long time, that really was the end of the story. But what if there's a flaw in how most of those big index funds are actually built? A little wrinkle in the system. Let me give you a perfect and kind of painful real-world example. The Yahoo problem. Most big indexes are cap-weighted, meaning they own more of the biggest companies. So back in December 1999, at the absolute peak of the dot-com bubble, Yahoo was added to the S&P 500. And this meant every single index fund on the planet had to go out and buy a ton of Yahoo stock, no matter how ridiculously overpriced it was. And the result? It was just insane. In the 5 days between when they announced Yahoo was joining the index and when it actually happened, the stock shot up 64%. Why? Because all the traders on Wall Street knew the index funds were coming. They were forced buyers, and the market took them to the cleaners, making them buy at the very top.
And this whole fiasco perfectly highlights the big difference in how you can build an index. The standard cap-weighted index is basically a popularity contest. It buys more of whatever's hot, which means it buys more of a stock as it gets more expensive, making it prone to bubbles. A fundamentally weighted index, on the other hand, is like the sensible accountant in the room. It weights companies based on their actual business metrics, like sales or dividends. It automatically sells what gets too pricey and buys what's cheap.
So, does this different approach actually work? Well, the history is pretty darn compelling. Look at this. Over almost 50 years, the fundamental dividend-weighted approach didn't just win, it won by more than a full % per year. It delivered higher returns, and it did so with less risk. That's kind of the holy grail of investing, right?
So when you take a step back and look at all this, maybe we've been asking the wrong question this whole time. Maybe the game isn't about the ego-driven quest of beating the market. Maybe the real goal is just to own it, to harness all of its incredible long-term power for building wealth. And if that's the goal, then the only question left, the really important one, is what's the smartest, most disciplined way to actually do that?
You know, every single investor at some point asks the same big question. How do you build a portfolio that can actually survive all the chaos we see today to deliver real, meaningful growth for tomorrow? Well, in this explainer, we're going to unlock the proven long-term strategy right from the classic book, Stocks for the Long Run. We're going to give you a clear, actionable plan.
So right out of the gate, you're hit with these two completely conflicting ideas. On one side, you've got John Maynard Keynes basically saying, hey, the present is what matters, and the market could feel like a total storm. But then, on the other side, you have Warren Buffett, who champions this almost infinite patience. The source material argues that you need a little of both. You have to act today, sure, but your actions have to be guided by a clear vision for the long run. Knowing that the ocean will eventually be calm after the storm is, as the book puts it, enormously comforting.
And that really brings us to the core question we're going to tackle. When the headlines are screaming and the markets are just going haywire, how do you actually build a strategy that respects the storm but doesn't get sunk by it? Let's break down how to do that.
So here's our roadmap for today. First, we'll get to the heart of the problem. We'll unpack the investor's dilemma and the psychological traps we all fall into. Then, we'll build the solution, step by step, laying out the core principles, constructing a portfolio, and finally tackling the most critical skill of all, staying the course.
Okay, Section 1, the investor's dilemma. Now, what's fascinating here is that the actual strategy for long-term success is, well, it's pretty simple. Just buy and hold a diversified portfolio. That's it. It's available to literally everyone. So the problem isn't the strategy. The problem is us. Our own minds are just wired with these powerful emotional triggers that can send us completely off the rails.
So let's talk about those psychological traps, shall we? These are the specific, super common mistakes that just derail our best intentions and, frankly, lead directly to worse returns. All right, mistake number 1, and is probably the most common one out there, trying to outsmart the market. I mean, we all hear the stories, right? People getting rich quick, finding those hidden gems that just explode in value. It's so tempting to start trading all the time, but the evidence is just overwhelming. That path almost always leads to high fees, terrible timing, and, you guessed it, poor returns.
And the second trap, it's our own mind playing tricks on us. It's called hindsight bias. You know, when you look back, the past just seems so obvious, so clear. It makes us think, oh, I knew that stock was going to take off. But we totally forget how uncertain we felt in the moment. And that false confidence, it just encourages us to bet on our gut feelings instead of sticking to a real, disciplined plan.
Which brings us to the biggest mistake of all, our own emotions. We are just hardwired to feel pessimism when the market is tanking and total optimism when it's soaring. And this leads to that classic, disastrous cycle, buying high because of greed and selling low because of fear. It is the absolute polar opposite of what a successful long-term strategy needs. So, okay, if those are the problems, what's the solution? Well, it's a disciplined investment strategy, one that's built on a foundation of clear principles that come directly from decades, even centuries, of historical data. This is where we stop guessing and start using evidence.
So here's the antidote. 6 core principles that form our entire discipline strategy. We'll start with your mindset, setting the right expectations, and really embracing a long-term view. Then we'll get into the tools, using index funds and going global. And finally, the tactics, tilting toward value, and maybe most importantly, setting firm rules to protect us from our own worst impulses.
Principle 1 is all about setting realistic expectations. History gives us a pretty clear target. For 200 years, stocks have delivered an average real return, that's after inflation, of about 6.5%. Now, I know that number might not sound super exciting, but think about what it means. The actual purchasing power of your money doubles roughly every 10 years. This isn't a get-rich-quick scheme. It's a powerful, proven engine for building real wealth over time.
Okay, principle 2, embrace a long-term horizon. The data here is crystal clear. If your timeline is 20 years or more, stocks have not only given you higher returns than bonds, but they've actually done it with less risk once you factor in inflation. So you really have to remember that time is the single greatest advantage an equity investor has on their side.
Principle 3 gets into how you should invest. Use low-cost index funds. Look, instead of trying to find that one hot-shot manager or picking the next big winning stock, the data shows that a much simpler path is way better. Since 1971, broad market indexes have beaten nearly 2/3 of the professional, actively managed funds out there. By just matching the market, you are statistically very likely to end up near the top of the pack. It's kind of crazy when you think about it.
All right, with those principles as our guide, it's time to actually start building this thing. And a foundation of any solid, modern portfolio has got to be global. It's just so important to look beyond your own home country's market.
And that brings us to principle 4, diversify internationally. I mean, just look at this. Today, the United States makes up only about half of the world's total stock market value, and that share is actually shrinking. So to be properly diversified, owning foreign stocks isn't just a good idea, it's an absolute must. The book's recommendation is really clear on this. Invest at least 1/3 of your stock portfolio in international markets.
Now, once we've built that globally diversified core, we can actually refine our strategy a little bit. This isn't about trying to pick individual stocks. No.
This is about strategically tilting our portfolio toward factors that have historically given investors a bit of an edge.
And that leads us right to Principle 5. Tilt your portfolio toward value stocks. So historically, these so-called value stocks, companies that look kind of cheap compared to their earnings and often pay higher dividends, they've actually outperformed the flashy growth stocks. And the theory is pretty simple. Investors get all excited and they overpay for a cool story for a rocket ship while they completely overlook the solid, maybe boring company next door, which often provides a much better return with less risk.
So we've covered strategy, we've covered diversification and portfolio construction, but you know what? None of it, absolutely none of it, matters without this final and honestly most difficult piece of the puzzle. This section is all about the psychological game.
This is really where the rubber meets the road. Successful investing, it turns out, is much more of a psychological challenge than an intellectual one. And that's why our final principle, to establish firm rules, is the most vital one of all. Think of it like a contract you make with your future self. It's a pre-made plan designed to protect you from the temptation of a bull market and the raw fear of a bear market. It forces you to stick to your logical strategy, especially when it feels the most uncomfortable.
And this quote just nails why it's so hard to stand apart from the crowd. Keynes brilliantly captured that social pressure we all feel. It is so much easier on our reputation to fail by doing what everyone else is doing, right? To follow the herd off a cliff? It's much harder to succeed by going against what everyone thinks is right. Sticking to your plan means you have to be willing to look wrong in the short term so that you can be right in the long term.
And so, we end up right back where we started. The principles for success? They're simple. The historical evidence? It's crystal clear. You now have the entire roadmap. So the final question really has nothing to do with knowledge and everything to do with your own character. Do you have the discipline to actually stay the course?